The risk on trade has been very strong, very long.
Positioning is very crowded, and people have already priced in most of the good news.
I don't think the bull market's over.
Earnings have been rock solid.
At the end of the day, it's going to be the earnings that is going to drive this market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday following a weekend of travel chaos, putting the Senate on course to help end the gridlock in Washington. As the White House says we could be risking negative growth this quarter, President Donald Trump is planning his next move, proposing a $2,000 tariff dividend for American consumers.
Look, this goes to the heart of the moment. People are very worried about cost of living. You saw that in the latest elections. You've seen this with respect to a lot of different sentiment polls. And President Trump is trying to convince them that things will get better and that any kind of deterioration in their cost of living does not come from tariffs, but comes from Biden policies of the former regime. What these rebates are is really up for debate, whether this is just sort of renaming some of the tax credits that already have been passed, or whether this actually is a rebate. And if it is, it raises questions about the national deficit.
The Treasury Secretary, Scott Bessent, doing a very good job of dancing around this issue over the weekend after not talking to the president directly about it, but offering some solutions to that $2,000 giveaway. It's not just that, though. There's a populist twist over the weekend coming from the White House. It's the $2,000 checks plus 50-year mortgages in the mix as well, looking to address the issues that everyday Americans have.
Bill Pulte is making the FHFA great again and making it relevant. Look, there are a lot of questions and obstacles for a 50-year mortgage to get off the ground. Nonetheless, you'd have to have some sort of 50-year treasury probably also. How would the Federal Reserve manage with this? There is a focus, though, on cost of living. And you have to really think about how this was the referendum on cost of living in the latest election. President Trump trying to pull out all the stops to say things really aren't as bad as you think they are, and prices are actually coming down. What you are seeing from the sentiment survey is a huge pushback from that. And this is really speaking to a lot of these proposals.
Apart from one group, I went through you, Mitch, so you don't have to. The one group that feels okay right now are the people who hold the most stocks. Equities close to all-time highs. Equity futures again up 1% this morning.
Yeah, this speaks to the idea of how much can the Fed really do if it continues to prop up stock markets and fuel some of the gains that we're seeing in sentiment and spending power at the upper echelons of Americans. You're seeing this across the board. You're seeing this across earnings. I think that the question really comes down to, and I know that John Williams of the New York Fed addressed this, there is an ultimate question of how much is that concern about cost of living an endemic problem with something that's a softening in the economy versus a separate subset that doesn't necessarily offset the incredible optimism you're seeing in the wealthiest.
The San Francisco Fed President Mary Daly joining us a little bit later this morning, joining us at 8:30 Eastern time, so look out for that. Assuming this government shutdown ends, got to make some assumptions here. Let's just assume for now, play along, this thing ends. How quickly do we get the jobs report, and how long do we have to wait for all the other data points we still haven't collected the data for?
So my questions this morning: how quickly do we get all the data releases? How much could these releases buffet markets? How much do people care, given the fact that they are delayed and possibly coming out? How quickly does air travel get back to normal? How much will any delayed holiday spending get back? Right? There's so many questions that people have been swirling around with. Respect to the data, how much do people actually think it's credible, given the fact that people are going back and saying, how did you feel 3 weeks ago? I don't know how I felt yesterday.
How many times has Annmarie said one weekend of travel chaos and this thing's over? One weekend of major travel chaos, and it looks like this thing might be over.
Well, and Transportation Secretary is saying that on Thanksgiving, transportation would move to a crawl, that you wouldn't have anyone showing up, because why should they? Because they're being paid $100,000 and not even getting paid, and they have to work other jobs. You start to wonder, if these are such crucial members of our society, why don't we pay some of these agents a little bit more and maybe have a different mechanism that doesn't get shut down every other year?
That's what I'd be saying in my year-end eval.
100%.
If I was them. Stocks are up this morning. Bonds are down, yields are higher across the curve. 2s out to 30s. 10s this morning up 3 basis points. Your yield on a 10-year maturity 4.13. Coming up this hour, we'll catch up with Lori Calvasina of RBC as stocks look to kick off the week on a firmer footing. We'll speak to the former Congressman Patrick McHenry as Democrats reach across the aisle, and Daly Peterson of the Conference Board with consumer sentiment falling to a 3-year low. We begin this hour with stocks rising as lawmakers take a major step towards ending the government shutdown. Lori Calvasina of RBC writing, we continue to think earnings are providing a solid foundation for the equity market, but the best part of the earnings story may be behind us. Lori joins us now for more. Lori, good morning.
Good morning.
What's in front of us?
What's in front of us is we've got to still contend with peak valuations. We've got earnings sentiment that's pretty good, but not nearly back to where it was in August when we were, baking in this much, much better than expected tariff environment. And I do think, as Lisa mentioned, we do still have some uncertainty on the data. I know that the data release I'm waiting for is not NFP, it's not CPI. I want the CFTC data on U.S. equity futures positioning. So CFTC, if you're listening, please get that to me very quickly, because we've, had this march up to new highs. There's a lot of thunder kind of rumbling in the distance, as we put it in the weekly today. I know you're going to have Dana on later, but the conference board data, they had an interesting question as well on stock market optimism, which was not back up to the tip-top highs, but was basically back up to levels that often mark the peak. So I think we do have to, sort of see, do we have sort of peak optimism around stocks right now in consumers? The CFTC data won't speak to the consumer side, but it'll give you a lens in terms of how the institutional investor community is looking.
You've cautioned this for a while, Laurie. This is not a one-way ticket to a year-end mount-up.
Yeah.
Is that falling on deaf ears?
It's interesting, because if you look at a lot of these stocks that have reported, we're having these big gaps down. So it feels like we're getting that garden variety pullback in individual names. It hasn't manifested the surface yet. I think the worst, kind of day on the drawdown, it's been down a little more than 3%. We think that should be at least like 5, probably no worse than 10, frankly, maybe closer to 5 than 10. But I'll tell you, John, we watch the valuation levels. And if we look at the S&P 500, just that top 10 market cap cohort, we had gotten up to 30 at one point. That's basically been the ceiling of the last 10 years that we just can't break through. And we've fallen back down to about 28 in our latest update. But it's still just not giving you a whole lot of room.
Is this the problem of the Mag 7 of the tech names, or is this a problem more broadly of the index?
It's a problem broadly. I do think the Mag 7, these kind of rumblings have happened as jitters over AI have manifest. That seems to be the only thing to really generate our bad down days. But if you look at S&P 500 X, the top 10 names, I think that PE is trading at around 17.8 right now. It got up a little bit over 18, and 18 has basically been its ceiling over time. So whether you're looking at top 10 market cap names, a good proxy for the Mag 7, or even just the rest of the market, it looks like we've got a problem with hitting valuation ceilings everywhere we look.
So this raises a question of how much we could actually talk about the market in aggregate versus according to sectors, given that it's a K-shaped market. I mean, it's a cliche at this point, and everyone kind of rolls their eyes. But there's a question here of, if you get Mag 7 or the tech stocks maybe plateauing here, you could get an index level that doesn't advance much, but actually looks healthier, with that kind of broadening out, and some of the other names really seeing a boost from, say, Fed rate cuts, from, say, more stability. How much do you see that as a realistic proposition?
So, look, I think the Mag 7, they just have to sort of behave, right, in order for the market not to have, kind of one of these major scares. The rest of the market, though, it's interesting. You've got slightly better valuations in terms of the headline level. Again, the trend versus history is not fantastic. They're more at the epicenter of the tariff issue right now. And if you look, say, at the industrial sector, we've seen margin expectations come down again in this reporting season. And that's actually, along with a few other sectors, dragging down the aggregate S&P numbers. I think that with rate cuts, one of the things our economist talks about is maybe the economy is not quite as rate sensitive as it used to be. Now, that speaks to kind of higher income consumers, right, who are doing more of the heavy lifting on spending, having cleaned up their own balance sheets. But we also know corporates have cleaned up their balance sheets as well. I know one thing we heard at our industrial conference a few months ago was one rate cut was not going to be enough. They didn't sort of weigh in on like what exactly 2 gets you. But the idea that, just doing a little bit of relief on the rate side is going to like get you off to the races. We've seen that kind of poo-pooed in both corporate earnings calls and, public events by companies.
I want to build on the Laurie Calvasina pushback. The other pushback we've had from you over the last several months has been on small caps.
Yeah.
And that's the first back-to-back weekly loss we've had for the Russell, going back to April, believe it or not, down by 2% on the Russell just last week. Is there more pain to come, do you think, for the small caps, even if we get additional rate cuts?
So, look, I will say small caps do have some room on valuation. It's maybe the one corner of the market. It's about 16.5 times. 17, 18 tends to be your peak, so there's not a ton of room. This is also why I want to see the CFTC data, because they were so out of favor on that data set. That was the best thing around the Jackson Hole timeframe to tell you to look for a trade, along with this idea of rate cuts. But I'll tell you, John, even small caps have cleaned up their balance sheets relative to history. A lot of people don't believe that, but if you go back to the period when the Fed was hiking rates, a lot of small cap PMs were telling me that on their earnings calls with their companies, the companies were making the case that their balance sheets weren't as bad as they'd been in the past. So, like, what kind of pop are you going to get? I think at the end of the day, you still need the hot economy, and we'll see what the data shows when we start to get it again. But all this alternative data we're getting doesn't tell me that we're in that hot economy period. And I'll give you one last little tidbit. We did some work. We were talking through this issue with clients over the last few weeks. And if you look at some of the quantum stocks that are big weights in the Russell 2000, when they were surging in October, that is what took the Russell 2000 up to its peak relative to the S&P 500. And since those quantum names have faded, you've seen that Russell give back a lot of that outperformance versus S&P. So we said in the weekly this morning, how much of this was rates and how much was it just these quantum names juicing things?
Are you suggesting it's all just the one trade, the same trade?
I think to some extent, it is.
Laurie.
I mean, I think you were even getting that kind of tech froth optimism seeping into small cap, and everyone thought it was rate cuts.
Out of all the issues right now, Stuart Kaiser at Citi lists them: consumer earnings, AI sentiment, Fed policy, limited macro data. What's the one that's flashing red for you? What's most problematic out of that list of four?
I mean, I think the one that's probably most important is the AI sentiment. I don't know that that's flashing the reddest, like maybe it's a little bit yellow right now. We've just heard consistently people who have been bullish on that theme are starting to get some sticker shock. So it's not that people are fighting the trade, it's people who have been there that are starting to get worried.
Laurie Calvasina of RBC. Laurie, always good to see you. Pushing back against that one-way ticket to a year-end mount up. Plus, I think a lot of cold water over the small cap trade over the last several months from Laurie and the team over at RBC.
The idea that there are such great valuations, maybe a little bit of pushback there, and then a question just of what can propel it, given the fact that you have seen some margin compression. And we've heard that from a number of them.
Things are doing better this morning. Equity futures up big time, higher by 0.9% on the S&P 500, just off session highs. With an update on stories elsewhere this morning with your Bloomberg Brief. Here with us now, Yahara Anand. Hey, Yahara.
Good morning, John. Treasury Secretary Scott Bessent says President Trump's suggestion of a tariff dividend could come via the tax cuts in his signature economic policy bill. Bessent making the statement when asked about Trump's social media post where the president said each American would receive a dividend of at least $2,000 from that tariff revenue. Meanwhile, tensions between the U.S. and China are continuing to show signs of easing, with China adding more than a dozen fentanyl precursors to a list of controlled exports to the U.S., Mexico, and Canada. The move represents a step in fulfilling China's pledge to combat the flow of synthetic opioid ingredients to the U.S. And Nvidia CEO Jensen Huang says he's asked TSMC for more chip supplies to keep up with booming AI demand. Speaking at a TSMC event in Taiwan, Huang says Nvidia's AI memory chip suppliers have scaled up capacity to support the company. TSMC CEO confirmed Wang's request, saying the chip maker expects record sales every year. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara later on this hour. Up next on the program, finding a resolution.
After 40 long days, I'm hopeful that we can finally bring the shutdown to an end.
This agreement will give Democrats control of the Senate floor for a vote on one of our top legislative priorities.
That conversation up next with the former House Financial Services Committee Chair, Patrick McHenry. Live from New York City this morning. Good morning. Tech earnings doing better so far this morning. Check it out. Nvidia up by 3%. Alphabet up by 2%. These big names performing better in the pre-market. Microsoft has not had a positive day since it released earnings 2 Wednesdays ago. Microsoft this morning positive by about 1 full percentage point. That's the story at the single name level. At the index level, we look like this. On the Nasdaq, the S&P and the Russell, positive territory, up by 0.9 on the S&P. On the Nasdaq, up by 1.4. On the Russell, up by 1.1. Under surveillance this morning, finding a resolution.
After 40 long days, I'm hopeful that we can finally bring the shutdown to an end. All of us, Republicans and Democrats, who support this bill know that the time to act is now.
This agreement will give Democrats control of the Senate floor for a vote on one of our top legislative priorities, extending the Affordable Care Act premium tax credits. This is important when Republicans control every branch of government.
So here's the latest this morning. The Senate advancing a bill to reopen the government after 8 Democrats broke with party lines to vote alongside Republicans. Bloomberg's Mika Sona joins us now for more. Mika, welcome to the program. Are we close to ending this thing?
Yes, this is the first time in several weeks that we've seen some significant action taken to end the government shutdown that's now wreaking havoc on the airline industry and starting to really impact people's pocketbooks when it comes to the federal workforce. But the Senate did vote to pass in advance this new compromised version of a continuing resolution, and the House is going to come back this week after several weeks in recess to take a vote on it as well. So we're seeing huge progress, but it still could be a few days.
What's pushed the change, Mika? Was it just one weekend of travel chaos that pushed the Democrats to cross the aisle and get this done?
Well, I think that there was a lot of pressure growing on, particularly on Senate Democrats that, were really starting to feel the heat. I know that a lot of the blame was taken on the Trump administration Republicans, but Republicans really never wavered in their position throughout this fight. So there was a bipartisan working group that really came to a compromise. They're guaranteed a vote on a package that could help extend the Affordable Care Act subsidies that were at the heart of the fight here for Democrats. As well as some reelback of RIFs and federal workers that were laid off will be reinstated, and federal workers are guaranteed back pay. So that's really the crux of it.
Making some progress. Mika, thank you. We'll catch up with you in the next hour. Typically, markets don't care about any of this. They look right through it. It's growth deferred, not growth derailed. And we catch up later, we bounce back, all of that. This felt different towards the end because of the data blackout, Lisa, that this was holding back the Federal Reserve from reducing interest rates. And therefore, just the idea of the government reopening gets you a little bit more clarity. Those on the committee that were worried about cutting without the data are going to have the data potentially in several weeks' time.
There's the fact that data is affecting policy. There's also the fact that everyone says that the longer that any kind of government shutdown goes on, the more economic pain there would be. And this is the longest government shutdown in history. People talking about the potential for it to stretch back past 40 days. So all of a sudden, you start thinking $1.5 billion a day. It starts to add up. You're seeing in the airline stocks this morning in particular because they are the ones that are on the front lines of any kind of ramifications.
Tough weekend if you're at an airport this weekend. Absolutely brutal. To build on that conversation, the former House Financial Services Committee Chair, Patrick McHenry, joins us now for more. Patrick, welcome to the programme. Are there any potential wrinkles down in Washington? Because this market has decided this one's over.
There are always potential wrinkles. Look, we're talking about human beings trying to do hard things with major disagreements on policy and approach, as we've seen highlighted over the last 40 days and then actually in recent years. So the wrinkles here are that you had just enough Democratic votes in the Senate to break the filibuster that enables a vote to reopen the government. The mechanism to that is as outlined by our correspondent. This is the same deal that the Democrats could have had in the first week of the government shutdown, the beginning of October. So nothing changed other than political pain and political calculus. It also gave the Democratic Party the opportunity to highlight an issue where they have strength, healthcare. They highlighted that for 40 days. That didn't move the political narrative. That didn't bring the president into the game on negotiations. And this remained a congressional fight while the president was actively engaged on economic policy and foreign policy. So hard to see that much changed here. And in many respects, you look at Washington, the markets look at Washington and say, same as it ever was. And that is in fact the case today.
Well, which raises this question in particular about Chuck Schumer, the Senate Minority Leader, who is one of the defections to a vote for the reopening of the government. You said that this doesn't look a lot different than it was earlier. What do you make of that decision, given the fact that some Democrats were saying there was actually some unity in the party for a bit to fight back or keep the government shut? What does this signify about that?
Well, two things. One, there is a divide within the Democratic Party. We saw that highlighted by two moderate governors elected in Virginia and New Jersey. That was a highlight that the Democratic Party wanted to make. But you also had the election of a socialist mayor of New York, which I know we've talked quite a bit about, with Mandami. And that also highlights the progressive left, where there's action activity in the Democratic Party. But major dividing point when it comes to Israel, when it comes to whether the definition of anti-Semitism highlighted within the Democratic left. And this this shutdown, this cave at the end of the shutdown for Democrats highlights the divide within the party further. The second piece I would remind my Democratic friends is when Republicans moved to shut the government down previously, it was dumb policy and dumb strategy. And what the Democratic Party did was buy that dumb policy and dumb strategy and double down on it for the longest government shutdown ever. Not really adept, and showed really a missed opportunity for the Democrats here.
At the same time, you have to wonder how the Republicans are responding to what the government shutdown really highlighted in a lot of circles, which is the cost of living concerns that really have become the preeminent economic and, frankly, political issue. How are they addressing it? How sufficient do you feel like some of the moves on that side have been?
Well, look, the party in power always has the onus on them to perform for the economy and to deliver on the pledges of the last election. President Trump rode a wave, winning all the 7 battleground states, winning the biggest election he's been a part of, and getting a mandate on cost of living, addressing the cost of living in the last election. 1 year in, we still see that highlighted from the populace, from the voting populace. This is the work that Republicans have to be focused on in order to be successful in the midterms in a year. And so I see that as a recurring theme that the Republicans are trying to address. They try to address it with tax policy. They've tried to address it with healthcare policy. The president's very focused on this with pharmaceutical costs, as well as overall costs that he's working through at the administrative level. So that is really the key issue. It is the hottest issue in America today, and it has not subsided because we've not seen the economic results that the president outlined. But he has more time before Republicans are back on the ballot 1 year from now.
What's your reaction to some of the proposals so far? We opened up the program by talking about the $2,000 tariff dividend, plus some conversation over the weekend as well about 50-year mortgages. What's your reaction to those proposals?
Look, I mean, to affect the cost of affordability, you have to address the cost of affordability. These are things that the administration can take an approach to, but it doesn't actually have a net effect in a long-term systemic way. We've got to actually get our economy going in the direction the president pledged during the campaign. The tax cuts have to start having an effect. The regulatory policies have to be more aggressively put in place, deregulatory policies, to get this economy moving again. And those are the things that are gonna have the positive impact on the American people. The two issues you outlined here would be helpful in the short term, but also that doesn't get to the substance of the issue of affordability, which tax policy, regulatory policy can have a better effect on.
Patrick, appreciate your take. Thank you, sir. The former House Financial Services Committee Chair, Patrick McHenry there. Shout out to Jarrett Seaberg of TD Cowen, who put this note out just last week. We expect Democrats will make the economy as the key message heading into the midterm elections next year. This may represent a risk to financials as the president may respond by embracing populist policies, including some he raised during the campaign. Something to watch after the developments over the weekend. Which also speaks to the $2,000 rebate from the tariffs. I do want to clarify something, correct something that I said. Senator Chuck Schumer did vote no after wobbling. There were some conflicting reports. This, though, to your point, this health crisis is so severe, so urgent, so devastating for families back home that I cannot in good faith support the CR. So there is this question of how both parties are going to make this the preeminent issue. There's certainly questions about his leadership right now anyway. And Jarrett Seaberg, just to pick up on that quote, Jarrett's talking about the potential to revisit some of the conversations they were having about maybe putting a cap on interest rate cuts on credit cards. Do we go back to that in the coming weeks and months? Now, the way you heard Patrick McHenry describe things was a shift towards deregulation. I just wonder if things might go in the other way. You know, there's this political circle that when it goes far enough, it unites on one end, and it feels like we're very much at that level. The problem is there is a real cost of living concern and crisis, and so there's a real question of how does that get fixed? And what you're seeing is a lot of companies are absorbing cost increases, which tells you, we really are in an economy where you are getting pushback from consumers. Can you have the hot economy that everyone is talking about without the participation of a pretty significant part of the U.S. economy? Got a hot market this morning on the S&P 500 higher by 0.3%, 0.9%. Up next, we'll catch up with Brandon Oglenski of Barclays following a weekend of travel chaos. Plus, Danny has your morning movers. Nvidia leading a tech stock rally. That stock is up by 3%. Bouncing back this morning on the S&P 500, higher by 0.9%. Bouncing back from these losses, the biggest weekly loss since early October on the benchmark. On the Nasdaq, down by 3%, the worst week since early April this morning, up by 1.4%. In the bond market, 2s and 10s, those yields look like this. Higher by 3 basis points on 2s to 359. 10s up to 412.58. Last week, basically unchanged on the week. But Lisa, we talked about this so many times. Unchanged on the week, but so choppy from one session to the next. Bouncing off bad data points, good data points, Fed doves and Fed hawks. That tension in that tug of war is really building going into next month.
This is a bond market without an anchor. We don't understand the data because we're not getting it. And frankly, we don't understand the reaction function. Right now, there is a 65% chance being priced into markets of a December Fed rate cut. That is down from 92.3% the day before the Fed rate decision last month. So it shows just how much you have seen a reassessment in value and what the Fed could potentially do.
Getting closer to ending this government shutdown in Washington, D.C. Bring on the data. There's a view that in the next couple of days, if it ends, you get the payrolls data from September almost immediately, and then the tough work starts. You've got to actually collect the information to put the data together for all the other months we've missed so far.
If you had questions about the credibility of data before, start looking at backdated data where people go around and say, well, did you have a job on this date? How did you feel about it? It raises a question of how much you can actually trade off this and whether the Fed's going to look at it at all or whether they have other metrics. They're looking at the alternative data like the Challenger job cuts, University of Michigan sentiment survey to really get a gauge of what they should do.
If you're building Fed policy on Challenger and you Mitch, we've got a problem, haven't we?
Well, what else are you going to build it on right now?
100 basis points if that's all we've got.
Well, fair point.
2-year bond yields this morning up by 3 basis points, 3.59 as we count you down to the opening bell. The cash open 3 hours away with your morning movers. Here's Danny with more. Hey, Danny.
Hey, John. Leading the charge in the general positive sentiment for equities markets this morning is Nvidia. Shares up 3%. So you have hopes maybe a government shutdown closer to coming to an end. But you pointed out just how poorly markets did last week. Nvidia was the poster child for that, too. Fell 7%. Its worst week since early April. So there is some dip buying going on this morning. Elsewhere, Robinhood, also one of the biggest gainers in the S&P 500 this morning. Vlad Tenev, the CEO, giving an interview to the FT where he said that they're going to be launching a new platform on Robinhood where retail investors can buy pieces of private AI companies. He didn't name which one. He didn't say whether they'll have OpenAI on there, but they'll have something. He basically said he's not worried about a bubble in AI. He just wants to give everyday investors access to those kinds of high-growing companies. So those shares are up just under 4%. Finally, the saga over Metsera, the obesity pill startup, has come to an end. The bidding war has finalized with Novo Nordisk bowing out. Those shares, ADRs in the U.S., are rising after that. Pfizer had matched Novo Nordisk's price target for it, which is about $65. Because we're not getting this bidding war unfolding and because that price that they're going to be paying for Metsera is below where we are right now, we're just under at $71. You're seeing Metsera shares fall about 14.5%, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, the Senate taking steps towards ending the government shutdown. 8 Democrats crossing the aisle supporting a deal to fund multiple departments and pay furloughed workers. The deal must be approved by the House later this week. Elsewhere, TSMC reporting slowing growth in monthly revenue. The slump coming even as Nvidia CEO Jensen Huang is seeking more chip supplies from TSMC to meet high demands. And finally, President Donald Trump floating the idea of a tariff dividend of at least $2,000. The Treasury Secretary, Scott Bessent, weighing in.
The $2,000 dividend could come in lots of forms. You know, it could be just the tax decreases that we are seeing on the president's agenda. You know, no tax on tips, no tax on overtime, no tax on Social Security, deductibility of auto loans. So, you know, those are substantial deductions that, you know, are being financed in the tax bill.
The president posting that every American would be paid, not including high-income people. The Treasury Secretary is getting very good at this game, isn't he? over the weekend, dancing around that post by the president.
So what President Trump was talking about was actually a $2,000 check. And then what we heard is maybe this is going to be a marketing ploy where some of the initiatives that have already been passed get rebranded as a President Trump tariff rebate. So it raises a question, which is it, right? Which is the preeminent concern? Is it trying to get people to understand that, yes, cost of living is a concern for this administration, or is it to try to plug the deficit and the revenue-driving aspects of some of these tariffs? That was clearly a nuance within what Treasury Secretary Scott Bessent was talking about as he continued to say longer term, this really is about bringing competition back to the United States, but it also can be beneficial for you with a tax benefit.
I think it's fair to say, based on that response from Treasury Secretary Scott Bessent, what he'd like this to be, right? I think it's fair to say.
There is not a mathematical way to make this work without causing a real problem in the bond market. Treasury Secretary Scott Bessent has said repeatedly he is very much a pro-American policymaker with respect for the markets. So he understands how far he can push, and the market pushback will put that into some perspective. Right now, this is not a bond market that would be accepting of a $2,000 check to every single American, especially given what happened the last time that we had a policy where people got checks. What do? They go out and spend it. What does that do? It leads to inflation. And oh, yeah, by the way, it also increases the deficit, not a bond-friendly kind of recipe.
Yeah, it would make that Fed decision even harder in about a month's time. Plus, of course, we've still got a Supreme Court decision about the tariffs themselves still to come maybe before year end. Let's turn back to the government shutdown, the longest ever. The Transportation Secretary, Sean Duffy, warning of major disruptions to air travel as Thanksgiving approaches.
You're going to see air travel be reduced to a trickle. We have a number of people who want to get home for the holidays. They want to see their family. They want to celebrate this great American holiday. Listen, many of them are not going to be able to get on an airplane.
Joining us now, Brandon Oglenski of Barclays, covering the major airlines, and has been following the news over the weekend. Chaos. Can you offer us some data? Just how bad were things over the weekend?
Yeah, good morning, John. Thanks for having us on. I mean, the stats are still not final, but I think it was close to 1 in 10 flights canceled yesterday, and 1 out of 3, if not even more, delayed. And I think that actually buries the fact that a lot of these delays were running in the 2 to 3 or 4 hours. We're even talking about your colleague that was like switched between many hubs in the U.S. So I really feel for anyone that had to travel, over the weekend. And we think, oh, it's like just for fun. But no, there's lots of things that you actually have to do, like from a family perspective, if someone unfortunately passes or you have a wedding.
Yeah.
But these events don't move. And unfortunately, we can't get our federal government employees paychecks. So I think what we're seeing is the compounding issue that these folks have gone now, about a month and a week or even longer without paycheck. I think for a lot of folks in this country, that would be a really difficult situation.
It's super difficult to assess, but based on your high-level assessment over the weekend, how much of that disruption was travel related to weather disruption and related to the government shutdown?
You know, it all gets blurred lines because what initially happened, the FAA came out, I believe, on Wednesday and said, hey, we're going to cut 10% of flights at the top 40 major airports, which effectively means a 10% cut system-wide because everyone flies into or out of the 40 major airports. But then they walked that back and said, we're only going to do 4% for the weekend. So we saw about a 4 or 5% cancel rate on Friday. That stepped up a little bit on Saturday. But the issue is once you get crews, planes, and everyone out of place, then you add in a little bit of mix of weather and TSA lines that were looking really terrible at most major airports yesterday. And that's what can really then spiral out of control.
Let's say the government does reopen on Friday.
Yep.
How quickly will it take for air traffic to normalize?
I would think you give this maybe a day or two, because generally you can recover pretty quickly. It takes about a day or 2 days to figure out where all your crews are, to get the pilots and the planes and the flight attendants in the right place. And assuming that TSA and FAA can get back to full staffing levels.
You know, Transportation Secretary Duffy was talking about how air traffic controllers work long hours. They have very stressful jobs. They make about $100,000 a year. We've been talking about recruitment issues. We've been talking about staffing issues for a long time. Why can't this be fixed where people maybe are paid a little bit more, given recruiting bonuses, trained, and maybe paid by an entity that's not going to occasionally shut down?
Well, it's a little bit antiquated the way we train FAA controllers in this country, and I think it takes about 2 or 3 years just to get certified to then be an actual controller. And that's where there's a lot of washout with folks that say, this isn't really cut out for me. So I think pay could be a piece of that. Now, remember, it's a unionized job, so it's contractual. But I think more importantly, we need to really look at the modernization of our ATC system. If we could walk into a control tower today, you would actually see paper slips, which is how we manage flights. even today. And I think everyone remembers the Newark headlines from this past summer when we had control scope outages and things like that. That doesn't mean the system isn't safe. It just means it's running on technology literally from the 1950s and 60s. We still haven't gotten really beyond that.
How much was the slowdown really due to the mandate from Transportation Secretary Duffy versus what actually was going on the ground?
Well, I should be careful in the way I answer this because I did speak to a few of the airlines, and I think they're trying to be very quiet politically. But I think the view is that the system was actually holding up through mid last week. And so potentially maybe this initial 10% and then they walked it back to a 4% cut was maybe more of a political negotiating tool.
Brenda, just to pick up on the airlines that you cover, who's doing well right now? Who bounces back from this quicker than others?
Well, it's going to be difficult for all the airlines to recover because when you start looking at 10% schedule cancellations, again, you're moving your crews and planes out of place. But I can tell you the good operators have really been Delta and United. Now that's both operationally and commercially. And it's a little bit easier for the large network airlines because between American, Delta, United, and Southwest, they each control roughly 20% market share here in the U.S., especially for the three network airlines. They have regional jets and regional airline partners. That's where a lot of the cancellations have been focused. So it minimizes impact on their passenger counts. That just means it's a little bit easier for those networks to recover.
On the S&P 500, we often talk about the MAX 7 and everyone else. In the airlines business, it just feels like Delta, United, and then everyone else. Is that the way you summarize things?
Yeah, I mean, we're not even talking anywhere close to MAG 7 valuations.
No, of course not.
We're talking 6 times EBITDA, if we're lucky. But yes, I think Delta, did it first. They said, look, we're going to decommoditize travel. And they've done a pretty good job of that. And United said very quickly, wow, we actually have a bigger network globally. Why aren't we doing the same thing? So I think two maybe slightly different cultures, but Scott Kirby in Chicago at United and Ed Bastian down in Atlanta has really got both those organizations trying to win.
Is American catching up?
Robert Eisman team down in Fort Worth, I think they're trying their best, but the profitability just trails those two pretty significantly. And I think there were some product and commercial decisions made years ago and a lot of stock buybacks that leaves them with a lot of leverage that puts them in a little bit more challenging spot.
Brandon, it's good to see you. Thanks for dropping by. Thank you. Brandon Oglenski there of Barclays, and a shout out to any of you who suffered from the fallout over the weekend because the delays. I heard from a couple of people who were at airports for like 6-7 hours waiting for things to progress and move along.
Yeah, and that is if their planes took off and weren't canceled midway. So we were talking about whether, you mentioned this earlier, John, whether it would just take one bad weekend for the government to reopen again. And it really does raise a question. Was it trying to up the ante earlier, get it done before Thanksgiving? Because ultimately, this is typically the key negotiating factor.
Look, we don't know what was in the minds of all these people who were involved, but certainly that's how things played out, right? One weekend and it looks like things are moving along and getting done.
My gut feeling is that air traffic controllers are pretty upset because they feel very devoted to their jobs. And if you actually speak to any of them, they're very assiduous about it. So the fact that they're getting blamed for calling out sick makes them very angry.
They're right to be angry and frustrated. If you're just joining us, welcome to the programme. Equities bouncing back. We're higher by 0.9% on the S&P. With an update on news worldwide with your Bloomberg brief. Back with us, here's Yahara for more. Hey, Yahara.
Hi, John. President Donald Trump pardoned people who were allegedly involved in the attempt to overturn the 2020 presidential election. Those pardoned included Rudy Giuliani, Sidney Powell, Mark Meadows, and several 2020 campaign aides accused of sending false elector lists from 3 states to Congress in an effort to keep Trump in power. Meanwhile, New York Fed President John Williams warning that the widening economic divide is a serious threat to U.S. resilience. In an interview with the Financial Times, Williams notes that while the stock market is up at record levels, high inflation and housing costs are forcing many to live month to month, calling the Fed's December rate decision a difficult balancing act. And Jeff Bezos-backed Blue Origin postponed a planned second flight of its New Glenn rocket due to weather conditions and unspecified ground equipment issues. The mission aims to send 2 spacecraft on a trajectory toward Mars for New Glenn's first NASA mission. It's seen as a crucial test for the company in its quest to challenge SpaceX. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the programme, consumers cutting back.
We have seen softer performance from or softer demand from lower income consumers. We're really seeing evidence that it's broadening out and rising up the income spectrum to more middle income households as well.
Up next, we'll catch up with Dana Peterson of the Conference Board. Live from New York City this morning, you're watching Bloomberg TV. So here's the bounce this Monday morning. Equities higher on the S&P by close to 1%, on the Nasdaq north of that, higher by 1.5. More to come, according to Mike Wilson of Morgan Stanley. Quote, while overhangs from Fed guidance and the shutdown have weighed on recent price action, these are temporary headwinds on the way to a solid 2026 driven by earnings growth.
Yeah, talking about how this earnings season has been much stronger than expected. S&P companies posting a nearly 15% jump in third quarter profits. This is what he's pointing to, saying maybe the headline level won't necessarily reach the heights that some people are expecting, but the broadening out will be substantial and there'll be a lot of opportunity there.
It's quite phenomenal, isn't it? Double-digit earnings growth. Can you imagine having that conversation at the start of April when the president rolled out that tariff policy, that we'd be sitting here 6-7 months later talking about double-digit earnings growth?
People would have said you're insane, and that had to mean that everything was walked back, which, I mean, it did come down from the highest levels, but it was not walked back. You just wonder how much that can be continued, particularly in consumer-facing businesses, given the pushback you are seeing from consumers. This is not an even economy, and how much does that unevenness matter on a more macro level?
Let's talk about that right now. Under surveillance this morning, consumers cutting back.
We have seen softer performance from or softer demand from lower income consumers. That's been happening probably for the better part of the last 2 years. And now we're really seeing evidence that it's broadening out and rising up the income spectrum to more middle income households as well. The middle income consumer, we know that cohort transactions have also declined.
So here's the latest this morning. Consumer sentiment sinking to near the lowest on record as high prices and the government shutdown weigh on spending. Dana Peterson of the Conference Board writing both present situation and expectations indices continue to edge downward as consumers persist in worrying about business conditions and the labour market. Dana joins us now for more. Dana, welcome to the programme. You follow consumer confidence and, of course, business confidence as well. How well aligned are the two at the moment?
They're pretty well aligned. Both businesses and consumers are wary about the economy going forward. Businesses are deciding that they're going to continue to just wait and see what happens regarding tariffs, as well as regulatory issues and fiscal policy. Meanwhile, consumers, we saw a big drop in consumer confidence earlier this year, and that's our measure, the Conference Board's measure, and it's kind of stabilized and moving back and forward over the last few months, but it's still much lower than it was pre-tariff announcements.
Dana, how unusual is it to see this level of anxiety about the labour market from consumers, whilst we run GDP at the levels we're running at right now, close to 3%?
Well, this is actually a new thing, apart from the pandemic, where over the last few years, consumers were mainly complaining about inflation, but not about their job prospects. This year is very different. Many consumers understand that tariffs can lead to higher prices, and also those higher prices might mean that businesses cut their workforces. And so we're just seeing like the natural progression of a pullback in consumer spending, similar to most recession threats. Now, most consumers think that there's probably a lower likelihood of recession going forward, but still in all, they're very much worried about what their job prospects are now for those who have been let go, and then also what job prospects might look like in the future 6 months from now.
Dana, how much dispersion are you seeing in the income groups with respect to confidence?
Well, it's interesting. Overall, the younger groups tend to always be much more confident than the older groups. And all three measures, meaning, under 35, between 35 and 55, and over 55, dipped this year. But we're seeing a little bit of a recovery, I think, as there's been some clarity, especially along the fiscal policy front, in terms of what spending and tax cuts will look like over the next decade or so.
One thing that we've seen over the past couple of years is that confidence and sentiment hasn't always cohered with people's spending patterns. They might feel terrible. They'll still go out and buy a big meal or buy a new handbag. How much are you tracking any kind of breakdown in that kind of dissonance? Because that really has been one thing people have continued to say. Watch what they do, not what they say.
Absolutely. And we do keep track of various spending on goods and also services. When it comes to goods, we're actually seeing a pickup in desires to purchase homes, cars, and electronics. And that could be a reflection of the fact that consumers are anticipating lower interest rates going forward. Certainly, the Fed did cut a couple of months ago, and once the shutdown's over, we anticipate they'll continue to cut. So we're looking at lower interest rates that might boost goods spending. When it comes to services, we are seeing a shift where consumers are engaging in cheap thrills like takeout or streaming over more expensive types of activities like travel. Also, we're noticing that consumers are focusing more on necessary services. So, for example, healthcare or car maintenance, while they're forgoing more discretionary and or expensive types of activities like going to museums or sporting events and even childcare.
Cheap thrills. The idea of taking out Chipotle. Woo! It's just a hilarious kind of example. I am curious going forward whether you do see any ramifications from the government shutdown, whether you think that any of the political dysfunction has made its way into some of these surveys, or if that's really just noise for the most part.
Well, we do ask consumers a question. It's kind of a fill in the answer type question where we say, what do you think right now is impacting the economy? It's not, we don't ask up or down or for the better or the worse, we just say impact. But people do write long things and certainly long answers. And certainly there's still a big focus on inflation. Tariffs have moved down a little bit, but we did see a pop in people mentioning the shutdown. And the sentiment on all of those things from people who wrote longer answers were all pretty negative.
Dana, just want to wrap up by some of the proposals and bring up some of the proposals over the weekend from the president. $2,000 checks, the prospect of maybe a 50-year mortgage as well. As an economist, how would that change your assessment of this economy if we started to see those kind of policies implemented in Washington?
Well, they do sound inflationary, and I'm not sure how many people would take out a 50-year mortgage. I mean, you're still trying to pay it when you're 100 and in a nursing home. So I also think that $2,000, you can spend that in a day for a lot of lower income and even middle income consumers. That's rent for many people. And so it doesn't address the issue that price levels are still going to be elevated because you're seeing these tariffs being pushed through by businesses. So it's kind of a short-term solution, but not really a long-term solve.
Dana, appreciate the update and the reaction. Thank you. Dana Peterson there, the conference board. I see this from politicians all the time, from both sides of the political spectrum. I've seen it in the UK with the housing market repeatedly. You need to do something on the supply side. You need to do something on the supply side. Look at this, I've got a demand-side solution. Look at this, I've got a demand-side solution. And we're hearing the same thing from Washington over the weekend. Give more money, have a better mortgage situation, not necessarily build more houses, because ultimately it has to come through the building mechanism. Look, this is going to be a question, and it's not just the $2,000 rate rebate idea, but there will be cash that will be given back to consumers in the beginning of next year as a result of some of the recent legislation. So you have to wonder what that's going to do, both on the inflation side, but also on the just economic activity side. And this is the reason why so many people who come on this show have been bullish. They're saying, wait for next year. It's going to be a pop. Speaks to the divide on the FOMC right now. We'll have more on that divide in the next couple of hours on this programme. Up next, we'll catch up with Sarah Hunt of Alpine, Saxon Woods, Jeannette Lowe of Strategas, Meghan Swiber of Bank of America, and Lindsay Piegza of Stifel. The second hour of Bloomberg Surveillance. Up next.
the picture for the economy on a go-forward basis is actually pretty decent.
We're still very much subjected to that K economy.
Inflation is still around 3. The labour market is still okay. What is the argument for cutting rates?
Our base case is for further easing.
There is only so much that monetary policy can do.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your scores look like this. We're bouncing back up by 0.9% on the S&P 500. On the NASDAQ 100, up by 1.5%. In the bond market, bonds down, yields up across the curve. 10-year bond yield so far this morning higher by 3 basis points, 412.58, as this government takes a big step towards ending a record-long government shutdown.
So the idea here maybe is that consumer activity will pick back up. If people were planning not to go on their Thanksgiving trips, maybe they can reinstate those family plans. They don't have an excuse not to see Aunt Becky, so good luck. But there is this question of how much this is going to potentially add to optimism that can also fuel some sort of Santa rally, which a lot of people have been expecting.
How orchestrated were the events over the weekend just to push these politicians to get something done?
I was called cynical last week for suggesting this, so I don't want to suggest that this was all political machinations. However, we just had a guest on who said that a lot of the airlines quietly are suggesting that there was capacity to deal with all of the flights that they had planned. Look, either way, it highlights that this always has been the pain point. There does seem to be some resolution to possibly move this forward and then to potentially get a vote. If there is a vote to reopen the government, what happens next? A flood of government data? A flood of questions around what that means for the Federal Reserve.
You hope, and I hope too, maybe a drip to start, the September payrolls report, and then you've got to do some real work. Do some real work to collect the economic data, all the little data points, to finally release the economic data to the general public.
If you ever were worried about the credibility of markets and the credibility of labor market data, or just market data in general, this is the time to do it, because not only have you had staffing cuts of some 30% in some of these agencies to collect the data, but you also are going back and asking people what they felt a month ago when they were getting laid off, and it's a different kind of story. A real question here about the accuracy and whether the Fed needs this, or whether they already have all the data they need to make a decision.
The data blackout, I think, became market negative last week for 2 reasons. Point 1 would be we started to put emphasis on lousy data when we typically wouldn't put emphasis on this kind of lousy data. Third-tier data like challenger job cuts suddenly became important. That's point 1. Point 2 is also, I think there was a consensus coming into this government shutdown that even without the data, the Fed wouldn't deviate from the median dart. I think Chicago Fed President Austin Goolsbee poured some cold water on that in the last week, and the bias started to shift. The view became that actually, because we're flying blind now, maybe they'd just wait. Maybe they'd wait another meeting and wait until we get some more data.
A real question around if inflation is running hotter than expected and we are getting such messy noise around the labor market picture, maybe we shouldn't cut rates in December. I keep going back to Fed funds futures, a 65% chance of a December rate cut right now priced in, down from 92% the day before the Fed meeting. So definitely cold water poured by Fed Chair Jay Powell, but the ongoing run of Fed speak has raised further questions about just how disparate the opinions in the Fed are.
Bond yields up today by close to 3 basis points, 10s at 412.38, equities higher by 1% on the S&P 500. Coming up this hour, we'll catch up with Sarah Hunt of Alpine, Saxon Woods as investors look to recover losses. Jeannette Lowe of Strategas with the Senate taking a first step towards ending the government shutdown, and Meghan Swiber of Bank of America predicting a December Fed pause. We begin this hour with stocks gaining some ground. Sarah Hunt of Alpine, Saxon Woods writing investors are seeking refuge in companies that demonstrate financial resilience, prioritizing steady dividend growers and firms with the strong free cash flow needed to weather a downturn. Sarah joins us now for more. Sarah, good morning.
Good morning.
There's some tech companies determined to eat into that cash flow, aren't they?
They are definitely determined to eat into it, and I think that between that and the fact that they're raising some debt is what's given some people some pause on the story right now. So I think you mentioned earlier today sticker shock that people are getting from some of these investments, so I think that there is an issue there.
So it's AI, the consumer slowdown. I mentioned that note from Stuart Kaiser of Citi. There's been a range of reasons for the pullback. What do you think is the dominant one in the last week?
It's interesting. I think it's really the and of all of it. And I think the government shutdown didn't matter until it started to matter. And when you start to see those pain points, people start thinking about when do we get this resolved? How do we get this resolved? And how bad does it make things going forward? And I think all of a sudden that started to matter. Again, you start to layer in enough things and it's the totality of them, I think, more than an individual one.
Is it noise or signal, the sell-off that we saw last week? Is it something that is viable and just a blip that offers opportunities? Or is it signaling that there is some weakness under the surface that needs to be paid attention to?
I think the magnitude of some of the declines on the misses gives you a little bit more pause than you would have normally. I think, there's nothing wrong with having the market stabilize and or have some sort of a downdraft for a while after hitting record high after record high after record high. So this is not like there's some massive change underneath, but I do think that there is some willingness now to look out and say these earnings better grow into some of these valuations, and or these valuations are on a high level. Markets don't generally correct because of valuation, but it certainly could give things pause. And I don't think you've seen a major downdraft here, but you definitely have seen some under the surface. You've seen a lot more percolating and bigger drawdowns than you normally would in individual names.
One thing that's raised some concerns, at least in conversations that I've had, is that one of the biggest players in this space is OpenAI. And OpenAI is a private company that's expanding very rapidly and has circular deals with all of the big tech players, and you don't have visibility into what they're doing, who they're hiring, how they're spending, or what their plans to grow in terms of specific new programming. How much does that give you true pause and actually make you lighten up some of your exposure to the AI players?
I think the real question is the functionality and how we are going to use everything. I don't disagree on the OpenAI, and I think that part of the issue was the sort of discussion around whether or not there needed to be guarantees or needed to be this or needed to be that. In the end, we're going to need a lot more power. Are we going to need as much as we think we are? I'm not sure. I think that there will be efficiencies in there. But I think that the overall build is going to continue. The emphasis on ChatGPT of all of the different large language models is one, but there are other ones out there. But I do think that the circular financing started to cause people to question it. And every time the questions come is when you start to see that NASDAQ wobble.
One reason why this has been such a difficult economy and market to call is because you have this sort of secular tech trade, John's talked a lot about this, overlaid on what could be a cyclical shift in the underlying economy. How much are you seeing a cyclical shift to the downside in some of the recent earnings reports, whether it's fast retailers, fast casual restaurants, or whether it's some of the other margin compression we've seen in other stores versus a sort of bottoming out in some ways, like the Mike Wilsons of the world seem to think?
Well, this is going to come down to, and this is where the data being not available is tricky. It's going to come down a lot to the labor market in the near term, because what is happening there is going to, I think, inform both the Fed and some other areas of what's going to happen next. And I think it's hard to figure out right now if that's an AI problem, if it's an inflation problem, if it's a cost problem. All those different pieces are swirling together, and without data, it's kind of hard to get a gut check on that. But I don't know that you're having a major change until we really start to understand how to use the tools. So I'm not sure that it's a secular shift in the labor market as much as we have some cyclical issues going on and some higher costs.
Sarah, something's going on though. Earnings growth is fantastic, so corporations seemingly are making money. Employment growth is terrible. GDP is tracking really well at the moment. Could change given the government shutdown, but at the moment tracking quite well. And yet employment growth is pretty terrible based on various indicators. What gives? What explains that?
I think it's a combination of there's still some scar tissue of letting too many people go and people not wanting to let people go if they think there's going to be some growth. But I think that the movement in jobs is part of the problem. It's sort of like the movement in houses is part of the problem, because unless you can get, it's interesting, they were talking about making mortgages assumable again, which they weren't for a while. Unless you can keep somebody's old mortgage, there's a lot of stuckness in the housing market. There's some stuckness in the labor market because people don't necessarily want to let people go and see what happens next. And I don't know how that resolves itself. In the near term, it's harder to get a job now than I think it probably was a few months ago. It's certainly, from a younger person's standpoint, very difficult to get a job, because when I talk to my younger people, they are quite worried about that.
50-year mortgages, that's the proposal over the weekend. Do you buy it? Does that make sense to you?
I think that your previous guest made a great point about the fact or you made a great point about the fact that that's a demand response and not a supply response. We need to be able to build more houses. So there's either a regulatory push that needs to change, something needs to happen where you actually get more affordable housing built. And that is the problem right now. Making mortgages go out to 50 years, sure, it's like car loans to 10. It makes it cheaper, but does it make sense? And is that what you want to do to yourself from a financial standpoint?
Makes it cheaper on a monthly basis, but over the term of the loan, makes it a whole lot more expensive.
And you're paying all the interest up front. So at a certain point, you're just paying the interest up front to pay the actual mortgage back when you're, 304 years old.
Congresswoman Marjorie Taylor Greene pushing back against this proposal as well. Where is she on the political spectrum right now? Really pushing back.
The circle, as we've been saying,
right?
It unites on the other end after it gets to a certain place. There is a populist tilt right now, and we have to keep pointing to what it is responding to, and it is the cost of living, it is some structural issues, and the real debate needs to be exactly what the best way is to fix those.
Sarah, I just want to finish on tech. You can do single names, so I want to bring up a single name. Meta and Microsoft have had a really lousy 30 days, and sitting out all this spending is Apple. And Apple has had a really, really good 30 days. Is there a story there?
I think that the difference between Microsoft and Meta on the spending is that Meta's had more of a checkered history on money spent versus Microsoft, where I don't think you can make that argument. I think that they're stuck in a problematic, we need more capacity than we have. And I think for Apple, there's been another story, too, because it's whether or not this is going to be a refresh year, finally, after all the years of hoping that it was going to be. So I think that there's some differentiation there. But to the extent that it's not putting any strain on Apple's balance sheet, and this goes back to the argument about balance sheets and cash flow, right? You want to make sure in an uncertain environment that those companies are running through the proper amount of cash and everything else. I don't think that's a problem for Microsoft or Meta, but I do think that on the edges, that's starting to make people more wary, which is why we like to look for lots of cash flow.
A month ago, though, the bias was so different. Everything with AI related was up and to the right and up and to the right aggressively. And a month later, we're talking about Apple as if it's spending discipline. And a month ago, we had people coming on the program saying they're missing the moment, they're not spending enough. Is it a feature or a bug, the discipline of Apple?
It's both, depending on exactly what the psychology is. And I will say that this year has not been rewarding the people who are more cautious with their dollars as much as it's been rewarding the people who are spending like crazy. But when people start to worry that that spending like crazy can't go on, they go right back to the folks where they think that there's some discipline there. So it could be a little bit of a back and forth. I think it's an and not an or.
Sarah, it's good to see you. Thanks for being here. Thank you, Sarah Hunt there of Alpine. Saxon, words on a tech story. Tech story's better this morning. Nasdaq 100 higher by close to 1.5%. The S&P 500 up by 0.9. Let's get you an update on news worldwide with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. The government shutdown may be coming to an end. The Senate voted 60-40 to advance a bill that would fund most of the government through the end of January. 8 moderate Democrats broke with their party leaders to advance the bill. The House also needs to approve the measure before it goes to the president's desk for his signature. Meanwhile, Pfizer won the bidding war for the weight loss drug startup Metsera. It secured the $10 billion deal after Danish drug maker Novo Nordisk said it did not plan to increase its offer. Metsera cited a call from the U.S. Federal Trade Commission regarding potential risks from proceeding with the proposed Novo deal structure. And President Donald Trump became the first sitting president in almost 50 years to attend a regular season NFL game yesterday. The president watched as the Detroit Lions defeated the Washington Commanders 44-22. There were loud boos from some spectators when Trump was shown on the video board standing in a suite with House Speaker Mike Johnson. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next, Democrats divided.
Democrats will not back down. Fighting to lower health care costs is a righteous fight.
It was our judgment after 6 weeks, going on 7 weeks of this shutdown, that path wasn't working.
That conversation up next with Jeannette Lowe of Strategas, live from New York City this morning. Good morning. This week is set up to be an absolute snooze. Check it out. As much as I love Governor Waller, these are the headlines for you. Governor Waller's coming up later this week. On Wednesday, he speaks. G7 meeting for Foreign Secretary, so look out for that, I guess. Some media earnings, Disney, Paramount. I'm not trying to sell this. There's nothing to sell. It's very, very quiet through the trading week, at least on the schedule.
I might get excited about a couple things.
Over 3s, 10s, and 30s.
There's 3s, 10s, and 30s in terms of the auctions. There are a couple of earnings that will be very interesting. CoreWeave out later today. I think that'll be interesting for the AI trade. Disney coming out. A host of others as well. So we do get, you were talking about some of the entertainment sphere. fascinating. We get a lot of Fed speak, and we can really dive into some of these deep issues because we have the time, because there really isn't a lot else.
If the shutdown ends and we actually get some data and they put the payrolls report on the calendar, then I'm all in. Things will look interesting.
So, do you hear that? Jonathan Ferro would like you to just put the payrolls thing back on, and then he can get excited again. Otherwise,
might happen.
He's going to strike.
You know, might happen by Friday. We'll see. And then everyone will say it's dated. We don't want September. We want October.
No.
I know, I want October too, but let's start somewhere.
They'll say it's dated, and then it will come out, and it will move markets dramatically. So, watch what they do, not what they say.
Equities bouncing back this morning, up by 0.9% as we take a major step towards ending this government shutdown. The Nasdaq higher by 1.4. Under surveillance this morning, Democrats divided.
Democrats will not back down. Fighting to lower health care costs is a righteous fight.
Those of us certainly participating in the Democratic caucus are 100% committed to working on the issue of the ACA premium tax credits. It was our judgment, after 6 weeks, going on 7 weeks of this shutdown, that path wasn't working.
So here's the latest this morning. The longest U.S. government shutdown moving closer to an end. 8 Senate Democrats breaking with their party to advance a funding measure with Republicans. Bloomberg's Mika Salner joins us now for more. Mika, is Minority Leader Schumer losing control of his party?
Well, there's been a lot of criticism of how Leader Chuck Schumer has handled this whole debacle. I think that he's facing a lot of pressure and critiques from not just his Senate colleagues privately and publicly, but also the House progressives and the majority of House members, Leader Hakeem Jeffries, even moderate members like Angie Craig of Minnesota, for example, are furious at this deal, saying that they're not going to vote for this when it comes to the House. Granted, it's likely to pass with just Republicans anyway. But yes, definitely Schumer has taken a lot of heat for not being able to keep his caucus together.
Mika, what are the next steps? Can you describe the process over the next few days to really end this thing?
Yeah, absolutely. So I think, once the Senate gets through here, all eyes are going to be on the House, who has been out of session for the past few weeks. Speaker Mike Johnson has to give 36 hours notice to members, and that means a lot of members will become flying in back to D.C. and or even taking long drives due to delays. But they're going to have to pass this, and then we're going to have to see what happens in the next couple of months too, when some of the funding levels expire on January 30th. But that's a fight for another day.
Yeah, let's just leave that there for now, Mika. I don't want to think about that. Mika Salner there of Bloomberg down in Washington, D.C. We're going to do this all over again very soon.
I really hope not, because that would really devastate a lot of people who are depending on this income and depending on these programs. So let's hope that that's not the case.
Jeannette Lowe of Strategas joins us now for more. Jeannette, welcome to the programme. A significant step. Any wrinkles you'd point out, potential wrinkles down in Washington that might delay this from ultimately ending?
Well, yeah, thank you for having me. So I would say, first of all, we had seen that over the past 2 weeks, members of Congress on both sides of the aisle had been moving towards figuring out how to end the shutdown. The pain had definitely been growing with federal workers not being paid, with SNAP benefits not going out. And then the FAA restrictions on airspace beginning on Friday really started to put some additional pressure on members to get to a deal. So we thought that coming into last week, there was a deal on the table. Both sides were looking to see what would happen in the Tuesday elections, see who would have the upper hand. Obviously, Democrats felt emboldened after that. But at the same time, the additional pressure of just what is going on with flight delays, people still not getting SNAP benefits, has definitely put pressure on members to come to a conclusion. And we basically have a very similar deal that was advanced in the Senate yesterday that was very similar to what we were seeing at the beginning of the week. There are some potential wrinkles here. Obviously, the Senate could uphold, or certain members of the Senate could uphold the vote and slow it down. So they're going to be looking to get unanimous consent to stay and see if they can actually get it out of the Senate today so that the House can then move. But that could be a potential issue and potentially delay it longer. Could House members have difficulty getting back into D.C.? That could be another issue. But they only need a few probably Democratic votes in the House to get this across the finish line, and there are probably enough to do so. So I think overall we do think it's going to be done hopefully by the end of the week, but there could be some wrinkles along the way.
Jeannette, has anything been accomplished in more than a month that the government is shut down in terms of understanding what the issues are, moving policy forward, preventing this from happening again?
Right. I mean, so one of the things that's always been an issue with a shutdown is the party that puts the shutdown into place generally does not win the concession that they were looking for to get the shutdown in the first place. So Democrats did not get an extension of the Affordable Care Act subsidies. Yes, they got a promise to have a vote in December or by December to do an extension. And that may be unsuccessful, particularly in the House. So that's not necessarily a win here. I think for Democrats, the one win that they can point to is pulling back some of the layoffs during the shutdown. That was an agreement. I think appropriators here are happier because at least they are starting to get some of these FY26 appropriations bills across the finish line, but generally the shutdown does not create a lot of movement. Democrats might also be able to point to the fact that they've raised the issue of healthcare affordability going into the 2026 midterms, but to your point, not a whole lot has been accomplished.
There's also a question politically of whether the tone has shifted, whether it was the elections that just took place or whether it's the government shutdown highlighting some of the issues that galvanize American voters. How much will cost of living concerns shape the remaining couple of months of this year heading into early next? The idea that the next few months are going to be dominated by proposals to try to cater to people who are worried about cost of living.
Absolutely. So, I mean, I think one of the things is that just, again, people not being paid, food stamp payments not going out, that has definitely put a lot of pressure on members to get this shutdown ended. And that is going to continue to be an issue going into the end of the year. Once we get into 2026, there is actually a lot of fiscal policy support for the consumer. There's about $150 billion of tax refunds that's going to come out in the February through April tax refund season. It's actually a 44% increase from what we had last year. So there is a lot of support for the consumer coming. But in the meantime, a lot of consumers are concerned about prices and affordability, and Democrats and Republicans have also kind of been noting this issue as well and talking about healthcare premiums and SNAP payments and grocery bills and things of that nature. So you are going to probably see more talk about how can we help the consumer long term, whether it's figuring out some other solution for the ACA subsidies, whether it's the talk of the tariff refunds, things of that nature. But I think that is going to be a big concern going into 2026 and the 2026 midterms. But we do want to highlight that there is obviously a lot of consumer stimulus coming from the tax bill that Congress passed back in July.
Jeannette, in moments like these, politicians are tempted to do bad things. And I wonder if we revisit some of the things on the campaign trail. For instance, TD Cowen raising this proposal. Maybe the president thinks about going back to thinking about capping interest rate costs on credit cards. Jeannette, could that come back on the table?
You know, I don't think that is necessarily something that they're going to be more focused on. I actually think that if they were going to do anything, it would probably be another tax rebate. You know, Trump obviously brought up the idea of these tariff rebates. Secretary Bessent kind of indicated over the weekend that it may just be tied to these tax refunds that are coming next year as part of the One Big Beautiful Bill Act. But I think they'd be probably more likely to do direct payments to consumers. The talk about the ACA subsidies not being subsidies anymore, but being direct payments to maybe like a health savings account for individuals, putting the money directly back into people's pockets. I think that's more likely at this point than some of these other proposals.
Jeannette, appreciate it. Thank you. Jeannette Lowe there of Strategas. Bramo, watch this space.
Yeah, this is going to be the node of all debate politically going toward the midterms, given the fact that this is the galvanizing factor. Ultimately, the incumbent party always suffers the blame for any economic woe that is experienced in real time, and this time is no different. People feel the overall price increase. So trying to convince them that inflation, the rate of increase is coming down is very difficult, which is why you're hearing some politicians, Scott Bessent, President Trump, coming out and saying, actually, prices will go down. How are they going to do that? The idea of deflation, outright prices going down, unless you get a China-like shock, similar to what we've been seeing over there.
The President Biden handbook of how not to do things. Don't pretend it's not happening, and then don't offer demand-side solutions to something that needs a supply-side solution. That's what I would say is the don't do things handbook from President Biden, how not to do things. There is a risk that they're tempted to reach for that handbook and do exactly the same thing. And that's a problem.
That's been the proposal so far, because that ultimately is the quick fix.
Up next on the programme, we'll catch up with Meghan Swiber of Bank of America predicting a Fed pause in next month's meeting. Plus, Daly has some morning movers for you. Taiwan semi shares rising despite slowing revenue growth. That stock is up by 2%. A much better tone to this market. Equity futures higher by 0.9% on the S&P 500. On the Nasdaq 100, higher by 1.4%. The Nasdaq bouncing off a 3% loss last week, the biggest weekly loss since early April. In the bond market, 2s, 10s and 30s shaping up as follows. Risk on. That means bonds are lower, yields are higher, up 3 basis points across the curve. 2s up to 3.59. 10s this morning up to 4.1277, going into a week full of bond auctions across 3s, 10s and 30s.
That's pretty much all that there is, so we're going to really ramp this up. We've got $58 billion of 3-year notes being sold today at 1 p.m. Tomorrow's Veterans Day closed, so really nothing going on, but we'll be here. Wednesday, we've got $42 billion of 10-year notes being auctioned, and Thursday, $25 billion of 30-year bonds. At some point, maybe you'll get pushback. The biggest takeaway from these auctions has been the incredible demand for income. And frankly, there is so much cash still sloshing around the system looking for income that has been the full story. Does that change? Can that change? Or is that continuing to be the theme?
Don't you think this show should follow the Treasury market calendar?
You know what I think. You're just baiting me. You're rage baiting me right now.
Should we be on air tomorrow? You know, Treasury market's closed. What are we going to talk about?
Should the weather be nice? I mean, come on, obviously. But we're going to be here and we're going to find lots of things to talk about. And probably it'll be one of the most exciting days that we could possibly imagine.
Snoozy week ahead for you.
Oh, come on.
If you didn't know.
Really?
If you look at the calendar, hardly anything on the schedule.
Watch, something amazing is going to happen tomorrow.
Danny's going to make it exciting with your morning movers. Danny has more. Hey, Danny.
I'll do my best, John. I guess if you own Nvidia, you're making money today, which is pretty cool and pretty exciting. That wasn't the case last week. Shares of Nvidia fell 7%, its worst week since April. So we are seeing a rally in the big cap tech stocks. Maybe some optimism over the government shutdown, too, helping things along. So much optimism. Even TSMC, the U.S. ADRs, are rallying despite the fact it reported earnings that saw some slowing growth. But Jensen Huang, which Nvidia, their biggest supplier, is TSMC, said that they're growing stronger and stronger every single month. So again, both those shares are higher this morning. We also had earnings from Barrick Mining. The gold miner obviously doing very well considering what the price of gold has been doing, so well that the CEO flagged the strong amount of cash flow they had meant that they could up their dividend. It's now going to be 12.5 cents quarterly, and they're going to do a 5-cent special dividend because of that cash flow performance coming in. And they're going to increase their stock buyback. Another $500 million have been authorized so far this year after $1 billion already. So that's 4.5% rally for Barrick Mining. Finally, ending things with HCA to the downside, the biggest loser in the S&P 500 pre-market, down 5%. This looks to be off the back of Dems getting closer to an agreement on the government shutdown, going forward with that procedural vote. The fear is that the extension of government subsidies when it came to the American Affordable Care Act was good for a company like HCA. Have Dems caved on this point? Sure, potentially reporting suggests that there will be a vote on this in December, but for now, those shares are falling, John.
That development behind a lot of market moves this morning. Danny, thank you for the update. More from Danny in the next hour. On our radar this morning, the Senate advancing a bill to end the government shutdown with the help of a group of moderate Democrats, but the passage of the short-term funding measure in the House is not guaranteed due to opposition from Democratic leaders. Elsewhere, Federal Housing Director Bill Boutle confirming work towards President Trump's pitch for 50-year mortgages. The administration making an effort to make housing more affordable, critics arguing the loans are more expensive with less equity. And finally, the New York Fed President John Williams saying financial strain on lower and middle-income Americans could threaten the U.S. economy. Williams telling the Financial Times the December rate decision will be a, quote, balancing act. Coming up at 8:30, so about an hour from now, we'll be speaking with the San Francisco Fed President, Mary Daly.
Yeah, and she came out with a blog post earlier this morning echoing some of the concerns that John Williams was talking about. And she asked this question: are we in the 1970s or the 1990s? We can't ignore the 1970s or the post-pandemic inflation run-up, but we can't ignore the rest of history either. Talking about trying to take into effect the overlay of the technological changes of AI versus a potential cyclical shift in how to identify either.
Do you point to the 70s or the 90s? What are you coming down on?
Honestly, I don't know the answer. I think that this really is a question in terms of how big of a shift is AI and how much does that really increase efficiency in a dramatic way? And how much do we implement proposals that lead to price increases and inflationary forces that start to accompany slower growth? And that is a similar kind of smell as the 1970s.
If we get $2,000 checks, it might make that decision a little bit easier.
Well, if that continues with anything else. Right. So there is this question of how do you deal with the fact that wages are not increasing very quickly at the lower end? And Torsten Slok pointing to that this morning, that's really falling behind. We were talking about that last week with Bank of America. And that really is, to me, one of the key questions. If you're not seeing wage growth and you're not seeing job creation, well, then what are we looking at a time where inflation is still elevated, but potentially what's the node for it to continue to increase if people aren't getting paid?
That's the tell right now. If you look at the labour market, what's behind this massive drop-off in employment growth? Is it demand cyclical or is it supply? Is it structural? And is wage growth the tell at the moment? Because of the industries that we depend on, immigration, you'd expect to see wages push up to attract that talent. Mary Daly's point, the San Francisco Fed president, is actually that's not what you're seeing. So that would lean me more towards cyclical factors than structural ones holding this labour market back.
She's saying it's a demand issue for labor. It's not a supply issue if you're not seeing the wages really go up commensurate with what you would be expecting, which makes her think, OK, hold on a second, there's something else going on and maybe the labor market needs more support. On the flip side, other people point to the inflation rate and the fact that it still has been high. And a lot of people are worried about cost of living issues. So at a certain point, you balance these two. It's a very difficult moment. And I'm not sure that 1970s or 1990s are the right corollary. Maybe it's the 2020s.
55 minutes away from tying ourselves into knots with President Daly. Let's stick with the Federal Reserve. Meghan Swiber of Bank of America writing, our House view is still that the Fed holds off on a cut at the December meeting and indeed doesn't cut again until the middle of 2026. Meghan joins us now for more. Meghan, good morning.
Good morning.
You're essentially saying that Chairman Powell's last cut as Fed chair was last month. He's done.
That's indeed true, John. You know, ultimately, the Fed reaction function that we see right now, and we're hearing this from a number of voters, is this caution around inflation. And, you know, I think to help answer this question of is it demand, is it supply related, look at some of the claims data. Claims is still quite low, which is a pretty decent sign to me that people are not being fired at large, at least in the private sector right now. And what we see in our BofA card data is still this resilience of the U.S. consumer and the importance of the consumer. We see, generally speaking, in terms of that leading what we look at from a labor market perspective. We usually see consumption lead labor, not the other way around.
So the last time they put out forecasts, which was September, they conceded the outlook hadn't really changed, but the risks around the outlook had, let's cut risk management. When they get together in December, the middle of December, and they have to put out new forecasts, are they going to say the same thing again? The outlook hasn't really changed.
Well, I think, John, it's really about this balance of risk assessment. And what changed in September and why they penciled in this additional cut at the December meeting is because they were viewing this risk more to the downside on the labor market. And we're thinking that that would drive more of a downside shift in inflation. But if we look at some of the inflation data right now, we're still seeing a lot of strength in services inflation. That tends to be more of the cyclical component of the inflation basket. And then again, we are also in, importantly, this absence of data from the Fed. Probably one of the first data points that we're going to get out once the government reopens is the September labor report. And in our view, that's going to be above consensus expectations.
Why aren't wages increasing more then, if this is the demand picture that you're talking about?
Well, while we are certainly seeing this cooling in hiring, we're not seeing companies turn to be outright firing folks. And so the reason why we're not seeing this uptick in wages is largely because we're seeing this shift from a supply perspective. AI may be one factor that's slowing the growth of employment overall, but we're not seeing this turn the other way around in terms of net firing right now.
If the Fed does cut rates, does that make you less likely to go into duration? I mean, how much does that affect the longer-term inflation backdrop?
Yes, and this is exactly the question that we're asking ourselves right now, Lisa, is how to think about December and the path for the Fed near term versus what some of these risks are for a Fed more medium, longer term. We understand Powell's reaction function pretty clearly. We have a nice indicator from a lot of the Fed speakers right now in terms of how they're thinking about this balance. But we worry about a new Fed chair that's going to be thinking about the balance of risks differently, namely not considering 3% inflation to be meaningfully above target. We're hearing some of those comments from Myron and Bowman right now that 3% is okay, or discounting that 3% inflation rate. And a new Fed chair may be more concerned about the slowdown that we're seeing in hiring, which we think is more supply-driven. They may be overweighting from a demand perspective.
Why isn't the current Fed also tacitly saying that 3% inflation is fine? Because essentially that's where it's been for quite a while, and it's been above that 2% level for more than 5 years. So at a certain point, maybe they're saying they're still going to get down to the 2% target, but at what point are they going to say it will get down maybe in 2073?
And this is a big issue for the fixed income market, because if you look at what the market's pricing for inflation in the medium longer term, they're giving the Fed full credibility on this. You look at where 10-year breaks are priced, considering that 30, 40 basis point differential between CPI and PCE, the market's giving the Fed full credibility on this 2% target. And if you do have a Fed that's getting more comfortable with 3% inflation, cutting alongside that, we see more upside to being long inflation. And we like that at the 10-year part of the curve.
It's kind of strange how well anchored market-based inflation expectations have been. How credible this pursuit of 2% seems to be when it's anything but based on reality, how the data's come in and how the Fed's behaved over the last few years.
It's something that I check almost every single day. Honestly, the five-year break-even rates and the 10-year break-even rates. And I've just been looking at where is the breakout going to come? It just has not come. And I wonder how much people are looking at disinflationary forces, whether it's from AI and accounting for that before accounting for some of the inflationary aspects or other things. I don't really have an answer.
I've said this week would be super snoozy with a caveat. I did say this in the last hour as well, that we might get some economic data. So let's talk about the data. You said above consensus expectations on payrolls once it's released. What's above consensus right now? What's good for the labour market?
A good number is just still steady job creation that's modestly above break-even. And break-even right now, the market thinks is probably much lower than what we had been seeing previously, call it around 50K or so. And a lot of that comes back to what Lisa's point was related to the supply balance that we have in the labour market right now, the slowdown in hiring. So any number that doesn't indicate an uptick in the unemployment rate, I think is pretty decent for the market right now.
So 60s, 70s is enough to keep the Fed on the sidelines?
I think so, John. And again, it's going to be this decision in the absence of us likely getting any more inflation data through the December meeting. We very likely had the last CPI print that we're going to get until the December Fed meeting. CPI was slated to come out the second day of the December Fed meeting, but inflation is not something that they can actually calculate retroactively. They do this survey throughout the month, and we're still now part of the way through November. Going to be a tricky one.
Okay, this is really important because I'm not sure how many people are quite aware of this. So you're suggesting that even if the government reopens like tomorrow, we move along, that they might not have CPI by the December meeting?
They may not, because oftentimes when the government's closed for a while, it takes them a while to actually get back to a normal production schedule in terms of publishing the data. So it's very likely that we won't get any more inflation data through the December meeting.
Meghan, thank you. Meghan Swiber of Bank of America, thank you very much. It's been too long. We'll have you back soon, I'm sure, no doubt. How long is it going to take to get that economic data? Because there's a lot of Fed officials trying to put together policy, and they need it right now.
And how reliable will it be? Are we looking at the right data? And I think that this was what Mary Daly was talking about also. Are we looking at the typical metrics if everyone can't agree exactly what they mean? And I think that needs to be an increasing part of the discussion, because even if we get that data, does it create more clarity about the path of this economy? I don't know. Every time we get the data, people just double down on their opinions and explain why they think that this absolutely supports that.
Confirm their priors. 100%. I mean, there's nothing too new about that, is there?
Well,
they become married to a view.
Yeah. But it feels more disparate right now because the view is less clear.
We've said a few times, cherry picking season in both the economics profession and in equities as well. Equity futures on the S&P 500 positive by 0.9% with an update on stories worldwide with your Bloomberg brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. A Paris court is deciding whether to release former French President Nicolas Sarkozy from prison. The appeal comes less than 3 weeks after he began serving a 5-year sentence for conspiring to use campaign funds from Libya. Sarkozy spoke in court this morning, reportedly saying his life in prison was very hard and once again proclaiming his innocence. Meanwhile, BBC Director General Tim Davie and News Chief Deborah Chernus resigned amid allegations the broadcaster misled viewers by editing Donald Trump's January 6, 2021 remarks in a documentary. Speaking after she stepped down, Chernus said mistakes are made, but the BBC's journalists are hardworking people who strive for impartiality. And a new court order says the Trump administration must fully fund November food aid benefits for low-income Americans. A U.S. appeals court chose not to block a judge's order requiring the release of full SNAP payments. The Trump administration wants to continue making only partial payments during the shutdown, arguing it doesn't have enough funds. That's your Bloomberg brief. John.
Yahira, thank you. Appreciate it. More from Yahira in the next hour. Up next on the program, the shutdowns, economic strain.
Thanksgiving time is one of the hottest times of the year for the economy. It's, Black Friday and all that kind of stuff. Right. And if people aren't traveling at that moment, then we really could be looking at a negative quarter for the fourth quarter.
That conversation up next with Lindsay Piegza of Stifel from New York City. You're watching Bloomberg TV. Just one weekend of travel chaos, enough to push the Senate closer to ending the government shutdown and helping to unlock these gains here this morning. Up by 0.9% on the S&P, on the Nasdaq up by 1.5%, on the Russell. Small caps up by 1.2%, following the first back-to-back weekly losses for the small caps since April. In the bond market, 2s, 10s and 30s, yields higher across the curve by something like 3 to 4 basis points. 10s up by close to 4 to 4.13, 2s at 3.59. A lot could change between now and the Fed's next meeting on December 10th, a month away. Andrew Hoddenhorst of Citi putting this out, that the Fed will likely have 3 additional jobs reports in hand by the time they meet a month from now.
Yeah, looking forward to having that open and some of the data. They might have the labor market reports, but as we were just talking about with Meghan, that we might not have the CPI report. So how much can they actually wait what we get from the labor market? I am curious about whether the fact that holiday shopping is not going to get disrupted by the government shutdown is really giving people a boost to the overall economy, and we're seeing that this morning.
You know we love to spend in this country, Bramo.
Never get between.
Get out there and shopping.
Yeah, never get between an American and their credit card.
Exactly. A few weeks away. Thanksgiving just around the corner. Equity futures then doing better on the S&P 500, higher by 0.9%. The Fed debate continues. Special programming, 8:30 Eastern time, about 41 minutes away. We'll catch up with the San Francisco Fed President, Mary Daly, at 8:30 Eastern time. That conversation just around the corner. Under surveillance this morning, the shutdown's economic strain.
Thanksgiving time is one of the hottest times of the year for the economy. It's, Black Friday and all that kind of stuff. Right. And if people aren't traveling at that moment, then we really could be looking at a negative quarter for the fourth quarter. I'm comfortable with 2% inflation. Inflation is like the Queen Mary, my friend Alan Greenspan used to say. And so when you go from the almost 4% that we had in January down to the mid-2s, then that's a trajectory that usually has momentum.
So here's the latest this morning. The shutdown adding to economic uncertainty as the White House estimates losses of $15 billion per week. Lindsay Piegza of Stifel writing investors will be listening closely to any indications of a growing divide among policy opinions, the threshold for additional rate cuts and broader expectations for policy going forward. Lindsay joins us now for more. Lindsay, welcome back. What is the strongest argument right now for this Fed to sit out the December rate cut decision?
Well, I think right now, when we look at the broader pace of economic activity trending near 3%, coupled with inflation still elevated well above the Fed's 2% target, I think it's going to be difficult to justify any further policy easing and really solidify the need for the Fed to take a pause, sit on the sideline, allow further data to evolve, and give the Fed a better sense of where we're headed going forward. But right now, not only is that justification not there, but the sense of urgency is far from there as well.
Lindsay, when we've been looking at other data points to try to backfill what we haven't been getting from the government, everyone seems to focus on the labor market. What metrics are you watching for inflation on the other side of things?
I think one of the key metrics that we're focused on right now is inflation expectations. Despite the fact that the Fed continues to vocalize a desire to get back to 2%, as we've seen over the past several years, they've failed to take the needed steps to ensure a return to price stability. And the market is seeing that. When we look at the latest inflation expectation calculations, near term still up near 5%, but longer term, so we're talking 5 years and out, still up near 4%. So there is a lot of concern that despite where the Fed is right now, further inflationary pressures may be coming down the pipeline.
Lindsay, you're talking about, I believe, the University of Michigan sentiment survey, because when I look at, say, break-even rates, it's still around the 2.2% over the next 5 to 10 years. So when you take a look at the market-based inflation expectations, they haven't risen. How do you explain that sort of a discrepancy?
Well, I think right now it goes back to the telltale story that we're feeling more inflation from a consumer standpoint than maybe the market calculations are presenting. That 2.5-ish to 3% range, consumers are feeling 20% increases, 30% increases, at least over the past 5 years across a number of key categories, from transportation, household energy, to your morning coffee. This has been compounding pressure on the consumer. And of course, as we know, inflation expectations feed directly back in to the realized inflation calculation. And this is something that the Fed has historically kept a very close eye on in order to not allow inflation expectations to be on further underlying inflationary data, this is one key data point to suggest the Fed needs to take a further, more direct focus on taming price pressures in the marketplace.
Lindsay, the last time we had a big moment with inflation was, of course, coming out of the pandemic, but it was easier for the Federal Reserve that time. Even though they took their time, it was certainly easier because the labour market was so tight. What's interesting about this moment, Lindsay, is that they feel not great about inflation, but they also feel pretty lousy about the labour market as well. And you see that across sentiment surveys. And Lindsay, I'm curious why you believe we're tracking so well with GDP and yet attitudes about the labour market are so lousy.
Well, I think when we look at some of the labor market conditions, we have to be careful not to put too much stock in one data set or one data point for that matter. First off, top-line job creation has slowed markedly over the past couple of years, but this is somewhat expected in an aged recovery, not to mention an ongoing structural shift with businesses increasingly relying on technology and the adoption of AI. So we no longer need 200, 300,000 jobs to reach that full employment level. Second, just because we see that one data point, again, top-line job creation is slowing, other metrics suggest we're on more solid footing. When we look at the unemployment rate, still near-ish 4%. When we look at wage growth, still up at 4%. When we look at jobless claims, still very range-bound as they have been for the past couple of years. So just as there's some indications of cooling, there's vast other indications that the labor market is far more solid than some of these more dire predictions.
So, Lindsay, just to follow up, because we've gone over this ground a few times throughout summer, Chairman Powell appears to have shifted his view on the labour market and the way he anchors his view around the labour market. He took your view of things at the start of summer. He anchored his view of the labour market around the unemployment rate, and then things changed through the summer, and he appeared to anchor his view around the deceleration we'd seen in overall payrolls. Where do you think we'll be by the time we get to December?
Well, I think it was pretty clear. We saw in this statement that the Fed downgraded their assessment of the risks on the employment side, but not necessarily in terms of forward-looking thinking, but as justification for the September and October rate cut. But Chair Powell clarified during the press conference saying that he does not expect any further deterioration in labor market conditions, suggesting that we may have reached this point of stability, further justifying then a position of policy on the sideline.
Lindsay, thanks for the reaction. Thank you very much. Lindsay Piegza there of Stifel. That's two guests back-to-back that appear to think this Federal Reserve should and will sit this out over the next few meetings.
People are concerned about the fact that inflation has remained higher than the target for more than 5 years. And there is this dissonance right now between how people feel about the overall price increases they felt over the past few years and the rate of change, the rate of increasing prices now. And that, I think, also is tying into people's minds. I just wonder how you explain that with the pushback that you're seeing from corporates in terms of what consumers are willing or not willing to pay with price increase absorption.
I will say this, many lessons coming out of the pandemic, many, but here's one. When the consumer tells you they're not feeling good about the labour market and or the broader economy, take them seriously. Because I'm not sure they were taken seriously enough with regards to the inflation story of a few years ago. And I think this time around there is a temptation to excuse this away. There's clearly a problem. They're telling you there is one.
And that's the reason why people are looking at tertiary data to try to understand the whole story.
Whether it's the Fed's role to fix it, that's a different question altogether. Coming up on the programme, Greg Boutle of BNP Paribas, Aneesha Sherman of Bernstein, San Francisco Fed President Mary Daly, plus Peter Supino of Wolfe Research. The third hour of Bloomberg Surveillance up next.
The risk on trade has been very strong, very long.
Positioning is very crowded, and people have already priced in most of the good news.
I don't think the bull market's over.
Earnings have been rock solid.
At the end of the day, it's going to be the earnings that is going to drive this market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures bouncing back higher by close to 1% on the S&P 500. On the Nasdaq, up by 1.5. A better start to a trading day as the government takes a big step towards ending a record long shutdown. In the bond market, bonds down, treasuries lower, yields up across the curve by 3 basis points. 10s at 412.77 into a week full of bond supply. Lisa running you through the numbers, 3s, 10s and 30s coming throughout the week. And watch this space on this calendar right here. because at some point when the government reopens, we're going to get a strong indication of just when you'll get that delayed payrolls data.
We believe that the September labor market report was already drafted, so it won't take that long for that to come out. If we get the data and it does confirm either strength or weakness, how much do people suddenly get a new anchor around the big question, which is, will the Fed cut in December? But more broadly, what is the longer-term neutral rate and how is the balance of risks shaping up on the FOMC?
Important conversation coming up 29 minutes from now. Fed President Mary Daly checking in with us here at Bloomberg Surveillance to break down what she's seeing in the labour market and whether the 70s is a decent way of describing this moment, or for that matter, is it the complete opposite? Is it the 90s?
Is it a question of stagflationary doom and a doom loop that you saw during the 1970s? Or are we looking at something that is a productivity boom on the backs of a technological revolution? And that would be the 1990s, albeit with some excesses built in from a stock market perspective. Nonetheless, it changes how they respond to policy. And there really is a key question of how do we even understand a labor market that does seem to be really softening amid GDP that's growing at a really healthy rate. It has been the mystery for so many people out there.
So many different points of tension right now that we're still trying to reconcile. I don't think a month's worth, 2 months, 3 months worth of data is going to address that problem. Just how are we tracking at 3% GDP with employment growth this low? Just how are companies doing this well with employment growth this low? And for how much longer can that story persist? And I've been asking that now for several months, and maybe it goes on well into 2026.
This is the reason why you're not hearing Fed Chair Jay Powell, or perhaps this may be the reason why you're not hearing Fed Chair Jay Powell say this is data-dependent Fed. You didn't hear that last time. Of course, we're not getting data, but how are you dependent on data that everyone interprets slightly differently? This is the key question. What is your framework? And I think that goes to the stock market, too. This question of, are we in a bubble? Are we not in a bubble? Do you see this as a huge technological shift, or do you see this as inflated valuations that are inflating everything and destined to maybe get deflated a bit?
We've certainly seen labour decouple from the broader economy. I'm not sure how much longer that can persist, but it's been going on for a while. On the S&P, we're bouncing back by 0.9% for the broader equity market. Better than good so far this morning. Coming up this morning, over the next hour, we'll catch up with Greg Boutle of BNP Paribas, with stocks rising to begin the trading week. The San Francisco Fed President, Mary Daly, on a divided central bank, and Peter Supino of Wolfe Research with earnings from Disney and Paramount Skydance on deck. We begin this hour with stocks rising as the possible end of the government shutdown opens the door to resuming the release of official economic data. Greg Boutle of BNP Paribas writing, the Fed, in our view, remains on course to continue the cutting cycle at the December meeting. We think this sets the stage for higher equities, but also high volatility. Greg joins us now for more. Greg, good morning.
Good morning.
If you've been tracking the programme over the last 30 minutes, we've had back-to-back guests saying the Fed will sit this out in December. Why do you think they'll be cutting interest rates?
Well, obviously, the macro data is not only delayed, but it's going to be messy once we get it. We've obviously had one cut for this cycle, and I think that if we view those as insurance cuts, the Fed trying to act preemptively for what may happen in terms of the labour market, then I think there's little reason to think that they won't act again in December.
Is there more space to deliver another risk management insurance rate cut with inflation closer to 3 than it is to 2?
I think it feels like it. I think the question is which part of their dual mandate do they focus on? And if people are worried about cracks emerging in the labour market, we know these things can get non-linear very quickly. That maybe is the part of the mandate that they'll be more focused on.
John mentioned some of the other people who were on the show talking about the Fed sitting this out, and they drew comparisons that sounded somewhat more similar to the 1970s than the 1990s. You say this is a market regime that is much more similar to the late 1990s. Why do you say that?
Well, as an equity market person, I think what we have going on there clearly looks more similar to the 90s than the 70s, at least at this point. And with the macro data such a mess, maybe the best thing to do is to focus on the micro data. We've just seen the bulk of Q3 earnings season, and I think Q3 earnings were undoubtedly good. You know, across the large cap tech space, we saw strong earnings that resulted in analysts upgrading their 2026 numbers. If we look further down the market cap spectrum, away from just that narrow mega cap tech, a lot of the industrial cyclicals posted pretty good earnings as well.
Is this just a story, though, of the AI build-out? Is this a story where you have a sort of technological shift overlaid on an otherwise weakening economy?
It could potentially be, but if that technological shift is one of the biggest pieces of the economy and the biggest piece of the equity market, and it remains on course for at least the medium term, the next year or so, then that can continue to drive the market higher.
Issue that we've got, Greg, is this is not just a technological shift per se. It's a corporate strategy shift. The way these companies are being run is changing as well, from asset light to asset heavy. What does that mean for how you value them?
I think it creates more uncertainty, and I think that is really at the core of our view, that we think we could see a higher market but higher volatility. The idea of these super cash-rich companies, having these incrementally higher capex spends that eventually have to become debt-funded certainly increases the risks. But that kind of increase in leverage, that arguably more efficient balance sheet, can also drive the market higher.
Are we beginning that debt cycle now? And how are you explaining that to investors about how they should navigate this moment?
Yeah, I mean, it certainly feels like we are moving on to the next stage of the cycle, but the question people have is that the late stage, is that the last stage of the cycle? And it doesn't feel like it. It still seems that we're in this environment where we're going to get really strong earnings growth, and we're seeing upgrades to those earnings forecasts, but an increase in leverage, an increase in debt, we think manifests in equities as an increase in volatility.
So it could be a bubble, but ride the bubble because you've got a lot of gains before it pops. Is that right?
Yeah, exactly. So we're looking back at things like the late 90s, and one of the lessons from the late 90s was if you got really bearish in something like 1998, that was a very painful lesson. And if we think back to 1998, it was the kind of mini Fed cutting cycle, which was the precursor to the strongest and most volatile period of returns from 98 into 99.
So wouldn't that be an argument that it would be a liability potentially and destabilizing for the Fed to cut rates now to just fuel a bubble that is developing and that a lot of people seem very worried about?
It could be, and that's the challenge for the Fed. There's a ton of crosswinds, an inflated equity market versus a weakening labor market, and the question is, which do they choose to solve for? And our view is that for US equities, if we do have this very strong earnings outlook and this AI capex cycle plowing on, and the Fed do choose to solve for the labor market and cut rates, that almost creates one of the most bullish and volatile scenarios for equity.
What's your credit team saying about this? Are they saying the credit market will accommodate this debt cycle, this leverage cycle?
Yeah, I mean, it's something that's obviously emerging for them with corporates that have incredibly strong balance sheets. So I think it's a story that the credit team are going to have to get to grips with, and it's going to be something that changes their market and is a kind of evolution for them.
Are they suggesting the credit market's wide open for it?
So at the moment, the credit market seems in a place where spreads are very, very tight, and there was huge demand for this issuance. So I think that for them and for us, it's more a question of kind of watching that stage of the cycle start to emerge and see where we are there.
We've seen the early signs of it, Lisa, at least over the last few weeks. Meta, Oracle, Alphabet with a monster one last week as well.
I'm struck by something that Bob Michael of JP Morgan Asset Management said. He said there is so much cash sloshing around right now, and there is so much money looking for income. And you have to wonder, when there's a lot of cash looking for a product, Wall Street will create it for them. So at a certain point, how much is the fact that there is a lot of cash in the system looking for some income going to fuel behavior just like this? To your point, John, earlier, rewarding the behavior that so many companies seem to be engaging in with releveraging.
I think you kind of alluded to this, but doesn't that make the equity story slightly more compelling, even more compelling?
I think so, absolutely. So that's where, when we talk about bubbles and cycles, the irony is if you think we're in a bubble, the right trade might be that we're at that expansionary trade of the bubble where risks do become larger, leverage becomes greater, but that's often where some of the best returns, albeit with some of the highest risk, occurs.
How would you characterise the pullback of the last week then, if we can call it that, a few percentage points?
Yeah, I mean, it's one of those things where going into this, we think things got very overextended. So we saw Bitcoin rally, gold rally, the most shorted names rally, NASDAQ rally, and we saw an explosion in call option volumes. So it felt like things were getting stretched. And I've described it as a healthy correction, where we've seen all of those assets kind of come back in concert, and we've seen some of the equity positioning metrics that we track kind of wash out. And as I said, this has come as against the backdrop where corporate earnings have been very strong. So I don't think this is really a fundamentally led correction, and obviously we've had the backdrop of the government shutdown and other noise in the background that's maybe contributed to that. But bigger picture, it seems to be more of a technical washout versus fundamentals that seem stronger.
Just to be clear, the correction that you're talking about is less than 3% last week.
Exactly. It's
okay,
a tiny
so this is not exactly a correction,
Yeah.
but I just want to make that very clear. I want to point out, though, that right now you're talking about all the reasons why you're getting more and more bullish. What would you see that would make you pause, that would think maybe this is not the story that I thought that it was?
The key driver of the bull market has been this boom in AI-driven capex. And if something happens to put the brakes on that, I think that could be something that could end up terminal for the bull market. But we don't see any signs of that happening in the short term.
Greg, this was thoughtful. It's good to see you.
Thank you.
Thank you, sir. Greg Battle there of BNP Paribas. Just as the equity market might have started to push back, debt market opens its doors and says welcome, and they issue a ton of debt.
And guess what? Everyone seems happy. The only people who don't, people will say it's just you guys who are nervous Nellies who are raising concerns about this. At a certain point, when you have a lot of cash in the system, it is looking for some money back. And guess what? Wall Street will find ways to give that to them, at least in the short term.
Futures up this morning by 0.9%. Some outperformance on big tech. On the Nasdaq 100, higher by close to 1.5%. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Treasury Secretary Scott Bessent says President Trump's suggestion of a tariff dividend could come via the tax cuts in his signature economic policy bill. Bessent made the statement when asked about Trump's social media post where the president said each American would receive a dividend of at least $2,000 from the money tariffs are generating. Meanwhile, Nvidia CEO Jensen Huang says he's asked TSMC for more chip supplies to keep up with booming AI demand. Speaking at a TSMC event in Taiwan, Huang says Nvidia's AI memory chip suppliers have scaled up capacity to support the company. TSMC CEO confirmed Huang's request, saying the chip maker expects record sales every year. Meanwhile, Tyson Foods shares are rising 3.6% in the pre-market. The nation's largest meat packer said it expects results for 2026 to be little changed despite record high prices for beef. Tyson's beef profits have been under pressure from a severe cattle shortage that's driven up prices and constrained volumes. Higher chicken demand has been able to offset some of those losses. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next, the morning calls, plus Aneesha Sherman of Bernstein warning of cautious guidance ahead for retailers. That conversation up next, live from New York City this morning. Good morning.
Both businesses and consumers are wary about the economy going forward. Businesses are deciding that they're going to continue to just wait and see what happens regarding tariffs. Meanwhile, consumers, we saw a big drop in consumer confidence earlier this year. It's kind of stabilized and moving back and forward over the last few months, but it's still much lower than it was pre-tariff announcements.
It's close to rock bottom. That was Daly Peterson of the Conference Board. Consumer sentiment not great, but this market does better as we open the door to ending the government shutdown and potentially the floodgates for economic data in the months to come. S&P 500 futures up by 0.9%, on the Nasdaq up by 1.4%, on the Russell up by 1.25%. That's the equity setup. Let's get you some morning calls. First up, Citi raising its price target on Nvidia to 220, expecting a beat and a raise in its next earnings report. That stock is up by 3%. Your second call from Stifel, raising its price target on Hyatt to 158, forecasting higher unit growth. And finally, JP Morgan cutting its price target on Target to 100, expecting a mixed earnings report next week. That earnings report next Wednesday. Target this morning positive by 0.2%. Let's stick with the consumer sentiment sinking to the lowest on record as the government shutdown and high prices weigh on the economy. Joining us now to discuss is Lindsay Dutch of Bloomberg Intelligence. Lindsay, just tell us where the consumer is based on what you're hearing from fast casual restaurants and what we're seeing from some of the retailers elsewhere.
Yes, thanks for having me. You're right, the sentiment indicator is low, but there are some positive signs coming from other sources. CNBC NRF Retail Monitor came out today with positive momentum in October, heading into the pivotal holiday season. And when I think about some of the hardlines retailers that I cover, there is some positive commentary coming from those companies, a Tractor Supply, a Somni Group, basically saying demand is resilient to improving, and that's really boosted mostly by a higher income consumer, but those consumers are still very selective and very value focused heading into the holiday season.
Lindsay, you talked about the high income consumer. What explains the divide between something like the travel stocks, which seem to be flying, excuse the pun, doing very, very well, and what we're seeing elsewhere, some of the worst performers this year, the likes of Lulu, the likes of Deckers?
Yeah, I think some of the retailers, the stock movement is in a reaction to, profit, which is reflecting tariff costs in this back half of the year. It also can be reflecting, outlooks. And a lot of the retailers are issuing, remaining very conservative on their outlooks. I cover Elf Beauty. They reported last week a very low outlook for the year, and the stocks do react to that, a lack of confidence that this back half of the year, could be solid.
Lindsay Dutch of Bloomberg Intelligence. Lindsay, thank you. Appreciate it. Aneesha Sherman of Bernstein writing the following. Going into third quarter earnings, off-price retail is holding up. However, we see a risk of cautious fourth quarter guides accounting for macro headwinds. Aneesha joins us now for more. Aneesha, let's go straight to the calendar. So next Wednesday, we should hear from Target. The day after, I believe, we hear from Walmart. What are you and the team expecting to see?
Across retail, as your correspondent just said, we are seeing some improvement in October. And so, August and September were weak. October looks a little bit better. However, I think as you put the quote up, I'm worried about Q4 guides. We had a very strong Q4 last year. The consumer was resilient. We had strong data up and down the spectrum, all the way up from Lululemon down to the hard value retailers. And they're now going to be anniversarying those numbers with a much weaker consumer. Sentiment dropping now for 4 months in a row, especially for middle income consumers, and pulling down towards value. So my concern will be very cautious guidance from those management teams in a year where there's a lot of uncertainty and consumer sentiment doesn't look great.
Aneesha, when you do your channel checks, how much are a lot of retailers going for volume, trying to squeeze their margins or not raise prices too much and try to attract the greatest number of people into their stores versus try to pass along some of those price increases and make up the difference on high margin items?
That's a great question. Going for volume has not been a winning strategy for retail. All it does is lead to a price war and a race to the bottom. And so, and this year, retailers are trying to do the opposite. They are trying to find ways to pass on some pricing. They've been burdened by tariff costs. So they're trying to find ways to pass on pricing on products that are working. They're not doing it peanut buttering a price increase across everything. They're doing it on select items that are selling well, new product launches that are doing really successfully, or items that appeal to higher end consumers who are more inelastic on demand and can absorb some of those price increases. So they are trying to salvage some of the margin that they've lost from tariffs. They're not trying to race to the bottom and cut prices on volume. Though if we get a really weak holiday season, we could end up in that situation in January. And so that's part of the concern around holiday guidance.
How much are you seeing a real kind of bind for some of the lower income or the discount stores in particular, given the fact that they don't have the same kind of flexibility to raise prices on key items to pad their margins?
They are doing some price raises. So the off-pricers, for example, are raising prices on select items. They're maintaining those price value gaps. And I think what protects them is they've seen full price retail take pricing up significantly, high single digit to low double digit across the apparel, footwear, and accessories sector. That's been the typical price increase for the last 4 or 5 months. So they now see room to catch up a little bit. They're not going to exceed that level of price increase, but they're going to maintain those gaps, or maybe even keep those gaps a little bit wider, but still take some increases. So they are doing it even at lower price points.
Lacey, another word I hate the most when it comes to retail earnings.
What's that?
Choiceful.
Oh, yeah.
Choiceful. Yeah. It implies they have choices.
Well, it also is a really nice way of saying picky,
right?
Because they have to be picky because they have a limited budget, and that's why they're going out and trying to make their dollar go the furthest
their
it possibly can.
Their choice set is constrained
exactly
by their budget. Why do we say choiceful?
Because it sounds nice. It's like they're full of choices. Yay, democracy.
But they're not. Aneesha, I have a problem with that word. Do you see a choiceful consumer or one that's constrained by tighter budgets?
I completely agree with you. I think choiceful and constrained are two very different things. You could see a high-income consumer being choiceful in the sense that there's a lot of new innovation and they're being choosy about what they want. We're not seeing that. We're seeing a constrained consumer now. We're seeing people that are trading down because they have to, and they're making difficult choices, cutting back on holiday spending, not because they're being particularly choosy or picky, but just because they're constrained. And that continues to be what pushes consumers down to those value retailers. So I think it will be positive for the value retailers, but everybody is going to see a tougher consumer making more difficult choices this holiday.
We saw so much of that play out with Walmart. Quarter after quarter, they talk about trade down. Aneesha, is that story largely played out?
I think there's more to it. I mean, they are trying to attract a higher income consumer base, particularly through the Walmart Plus membership and so on, and then keep that consumer as sticky sticky spending on across the portfolio. So they are continuing to do that. I think they will continue to be able to do it because they continue to have better assortments as well and better price points because of their size. So I think that trend continues, and it comes out of maybe more middle-income retailers or smaller retailers that maybe can't keep up with those assortments and price points.
Aneesha, to that point, is Walmart still the bellwether for the U.S. economy and the U.S. consumer, particularly on the lower end? Or do you have to look elsewhere? Are there other retailers that are better bellwethers?
That's a great question. It is the bellwether in general across retail, across the consumer. But when you're talking about low-income consumers specifically, it used to be very much so. And now there are other retailers that are more representative. If you look at the off-price retailers, the dollar retailers, some of the hard value retailers, they will probably tell you more about the lower-income consumer than Walmart necessarily will anymore. Walmart has become more broad-based and pulling more from high-income cohorts. So it's not a very low-income indicator anymore.
Aneesha, just heading into the holiday season, one thing that we've been focused on is how much holiday hiring there actually has been. And there have been signs that some of these retailers are not hiring as much to fill their stores as they have in the past. What are you getting the sense of in terms of that particular hiring spree?
They are being very careful. They're trying to manage their P&Ls. They're trying to manage their labor costs. This is not a holiday season where they're going all out. So yes, they're being very careful, tightening the belt. Not just on hiring, but even on kind of marketing into the holiday, visual merchandising. Everything is managed very tightly because they are expecting the consumer to come in with a tighter wallet. And so they are responding in kind and trying not to make the compares too difficult year over year versus a very strong holiday period that we had last year.
Aneesha, one final question before you go. Two of the worst performing names on the S&P 500. I know you've got calls on both, Lulu and Deckers, both down around 50 to 60%. Dreadful year for the stocks. Into 26, what's your message to anyone tempted to step in, pick up the pieces and buy these names?
Short term, I wouldn't. I have a neutral on Lulu and I have a sell on Deckers. I think they've both had self-inflicted mistakes that have driven this terrible performance through the year, and numbers have come down through the year. I think medium term, I'm more optimistic on Lululemon because they have had such a tough year. On Deckers, I'm inherently negative. I mean, I think they are not prepared enough to pivot into other areas. They're very focused on running, which is a super competitive sector. And I haven't seen indications that management are thinking more long term.
Aneesha, thank you. It's always good to see you. Make sure on the call you start, criticising some of these CEOs about the word choiceful and all that kind of thing. Aneesha, thank you very much. Aneesha Sherman of Bernstein doesn't need me to tell her what to do.
I was about to say, this is your lobbying call. You're like, please represent me.
I should dial in on the media call and say that.
Let me just tell you.
Yeah, I just hate that word.
I know, it does imply.
It's ridiculously misleading.
It's a very positive spin on an otherwise cyclical call on exactly where we are and the power of the consumer.
I'll take a step back. Coming up on the programme, San Francisco Fed President Mary Daly. I'll take a step in on what a divided central bank means for interest rates. Plus, Danny's going to join us with your morning movers. CoreWeave, a name that Lisa's looking at this morning as well. Shares bouncing back after last week's double-digit plunge. That name is up by 5%. That conversation just around the corner. 60 minutes out from the opening bell, equity futures shaping up as follows. A bounce back in this market off the back of weekend developments in Washington, D.C., taking a significant step towards ending a record-long government shutdown. On the S&P, higher by 1%, on the Nasdaq up by 1.5%, with some single names. Your stock movers this morning. Here's Danny with more. Hey, Danny.
Hey, good morning, John. You're seeing CoreWeave after shares falling 22% last week, and the whole fear of the AI trade hasn't gone too far. That's starting to reverse thanks to the fact that, one, there's a more positive sentiment today, and two, CoreWeave will be reporting earnings after the bell tomorrow. So those shares up today, rather. So those shares up 5.2% in anticipation of that. We also have some deal news that developed over the weekend. The bidding war between Pfizer and Novo Nordisk over Metsera. They are developing developing an obesity pill. You had Pfizer match Novo Nordisk's bid price for it, and then regulators came out voicing some uncertainty about what it would look like if Novo Nordisk bought Metsera. All of that meant that Novo bowed out of the race, and it does mean that the bidding war has ended. So you're seeing Metsera shares fall about 15% in today's trade. Finally, we got a little bit of earnings today. 90% of companies in the S&P 500 have already reported, but Instacart reported earnings this morning, a outlook that at the high end exceeded expectations. They also talked about the fact that they had a lot of growth coming in and a lot of positivity from different partnerships they have, for example, saying that all of that outweighed any of the issues with SNAP benefits being taken away because of the government shutdown. So those shares up 7.6%, John.
Danny, thank you. More from Danny in about 29 minutes' time alongside Matt Miller for Bloomberg Open Interest at 9 a.m. Eastern Time. Let's turn to the Federal Reserve. Policymakers remaining divided ahead of the December meeting. The San Francisco Fed President Mary Daly writing in a blog this morning, we must ask ourselves, are we in the 1970s or the 1990s? We can't ignore the 70s or the post-pandemic inflation run-up, but we can't ignore the rest of history either. The Fed President Mary Daly joins us now for more. President Daly, welcome back to the programme. Always good to see you. Let's just start with that question that you ask yourself. What's guiding your assessment of where we are?
So I'm looking at both inflation and productivity. And if you look at inflation, you're seeing that it's been pretty contained so far in the goods prices, which have been directly tariffed. And then you look at the other parts of inflation, you just don't see much of a run-up. So that's good news. And inflation expectations, what people expect, remain very well anchored. Look at productivity, and you see that productivity is rising, GDP growth is rising, while the labor market is slowing. So that tells me there's a little bit of that boost coming from firms looking to do more with less, but that's also causing a slowdown in the labor market. So the 50 basis point adjustment we've made has helped support the labor market, but still keeps policy restrictive so that we can put downward pressure on inflation.
President Daly, what are you looking at to determine whether it's the 1970s or the 1990s?
Well, I'm going to really look at things that improve productivity, to think about the 90s, and it's more than just the stock market valuations for AI companies. It really is about the companies out there who might be using AI, and then asking them, going directly to them and asking them, what's it doing for your bottom line, and how are you using it? And what we're hearing are pretty encouraging but very early signs. They see how it can help their bottom line, how it can improve their productivity, even how they can be supportive of their workers, give them more interesting work, take the less interesting work away. But they all tell us it's early days, so more to come on that. And then on the inflation part, are we in the 1970s? Really asking employers and firms, what are you doing with prices? Are you thinking about raising your prices? How are you going to think about losing volumes if you do so in a slowing economy, especially for consumers, from the 50th percentile down? And putting those two things together, I think we'll get a lot of clarity about which direction we're heading. And with policy, been slightly adjusted, we are in a good place to continue to evaluate the information before we make any decisions. We can't know ex ante before the data come out and before we get that information, really what we're facing. We just have to have an open mind about which one it could be, and maybe other periods of history I didn't even mention.
President Daly, how different would the neutral rate be if it were, say, more like the 1970s or more like the 1990s? Just how different would Fed policy be in response to one or the other paradigm?
Well, there's many nuanced ways it could affect the neutral rate, but I can back up from that and just ask what were the policy remedies. If you think we're about to have an inflation run-up, then we obviously would have to hold policy tighter for longer because we wouldn't want that to occur. Honestly, Americans have endured already too much inflation, and we really need to get that back down to 2% to restore price stability as we've committed to. On the other side, if it's productivity, you would start seeing the economy able to run a little bit longer. Maybe if you go back to the debates of the 90s, we saw the labor market slow. Workers were insecure, but the labor market had unemployment that was fairly low. And many at the time were worried that could spur inflation. But Chairman Greenspan held on with his colleagues. They didn't raise rates. And what you saw was, the 90s, which was a booming time. And we ended around target inflation, and we had a productivity boom. So you're trying to balance those two things together, and it means not looking just at headline information, but getting below that information, talking to firms, talking to consumers, talking to workers, really on the ground work like we do at the reserve banks and other places. You know, the Fed is built to do this on the ground work as well as look at the published data.
President Daly, reading the blog post this morning, it seems like you're leaning more toward the 1990s side of things than the 1970s. Is that right?
Well, you know, right now, you know, I'm in the West. I have the 9 states in the Western United States, and it's not just Silicon Valley that seems interested in AI. No matter who we talk to, whether they're, you know, small businesses, medium or large businesses, manufacturing, tourism, et cetera, they're using AI in a way that they say is going to improve their productivity, and they're already seeing parts of it. So when I see that, I'm like, okay, we need to think about that. What really will spur this as an ongoing thing is if they start to change their business processes. So that's what I'm looking at. Now, that means, but I guess a different way to say that is we cannot take our eyes off inflation. Again, Americans have endured high inflation too long. That's our mandate. So while I'm looking for productivity gains and seeing if they're going to continue, I'm also keeping my eye completely focused on inflation to make sure that it doesn't pick up in a way that would suggest we need to do more or we need to hold longer.
President Daly, how would you respond to the criticism that the Federal Reserve as an institution has taken its eye off inflation, that inflation is closer to 3 than it is to 2, and the Fed's been cutting interest rates?
You know, I don't think that if you unpack the inflation data, you really see signs of that. It's true that headline inflation is printing at that level, but you have to take apart that inflation and ask how much of it is the effective tariffs passing through to goods prices that we expect to be a one-time price level adjustment and not a consistent run-up in inflation. And if you unpack the data, what you see is you don't see inflation running up in services or housing, and importantly, you don't see it spreading into inflation expectations that would be the thing that would continue to run up inflation going forward. We also see a labor market that's softening and wage growth that is moderating, so you're really not going to see a lot of pressure coming on the cost side of labor. So I put those things together, and we don't want to make the mistake of holding on too long for rates, only to find out we injure the economy.
President Daly, can we just pick up on the cost of labour? I think this is really important right now. Clearly, and it's hard to dispute this, it's in the data, we've had a massive step down in payrolls growth. What's behind that is a little bit more confusing. Is it demand? Is it cyclical? Is it structural? Is it something else like immigration? What's your tell right now? What can you point to that helps tell you it's one thing over the other?
Yes, you look at prices. In this case, the price of labor is wages. If it was simply about supply and firms were still scrambling to find workers to fill what was jobs that were supported by the previous immigrants, you would find wages going up as they bid for workers to try to fill those jobs. But that's actually not what you see. You see wage growth slowing, even in sectors where immigration played a larger role. And so that, to me, says it's a demand shock, a negative demand shock, along with just a coincidental negative supply shock. So you lost workers, but you lost jobs at the same time, or you had job growth slowing. And what we're seeing now is does that continue to net out, right? What if the supply of workers doesn't keep going down, but the demand for workers does? Well, then we'd end up with a rise in unemployment. So have to keep squarely focused on those types of things. We're definitely in a low hiring period, and interrogating that labor market, continuing to watch the information, see what firms do next. That's going to be the important part.
And it's something that a lot of people have said really is the K-shape, the idea that particularly on the lower end, you have not seen wages keep pace with the rest of the income spheres. I just wonder, though, how much we are seeing a massive amount of inflation in asset prices and how that feeds into what you're looking at, especially at a time that may rhyme with the 1990s. And we know it happened after the 1990s. How much do you weigh that? How much do you have to pay attention?
Well, you know, one of the things that you do, so financial market conditions are one input into our decision making, one of many inputs. You know, we have two goals: price stability, full employment. We're trying to think about what inputs affect those two variables, those two goals. But what I look at is, if you look under the valuations, people are really talking about one of two things. This is going to be a transformative technology. AI is going to change the world to be like electricity or the steam engine. And then the people who are a little more skeptical are saying it's going to be a business as usual technology. Think of computers and the internet. The thing that's true about both of those is they're both productive. You get productivity from both of those. They both help with growth. They both help the pie in the U.S. expand. And so we're not talking about a bunch of ideas with no backing. We're talking about, equity investors, not highly leveraged, going in and making bets really on whether it's going to be transformative or business as usual. But everybody agrees on one thing: it will change productivity.
At the same time, President Daly, some people would suggest that, yes, you will see stocks continue to go up in the face of another rate cut. But at the same time, the transmission mechanism of the additional cuts are slower to take place. It's less efficient in terms of the pass-through, just based on how much lending there is, whether it's in the private lending sphere or beyond. How do you measure these things at a confusing moment?
Well, I guess this argument that we've somehow lost our power, monetary policy doesn't transmit, I simply don't see it in the information. If you go out and you look at what happened when inflation was running really, really high, we raised rates pretty aggressively, and mortgage interest rates rose rapidly, car loan rates rose rapidly, and the economy slowed, inflation came down. Right now, what I'm seeing is we adjust rates, mortgage interest rates come down, not one for one. That's not how it works. Usually it's less than one for one, but they come down. You see a little more activity in the housing market. You see a little more activity in the borrowing market more generally, and you see that dynamic work. So I guess the most important thing is just to remember that monetary policy acts with a lag, and right now we're making decisions not just for what's going to happen next week, but what's going to happen in the next 6 months to a year. So that's how we have to think about it with our forecasts, and then how we adjust policy as those forecasts evolve.
How frustrating has it been not to get government data?
I really want the information, the fullest amount of information we can possibly get. But one of the things that I think may be underestimated in public about what the Fed does is we're regularly relying on government-provided data. That's the gold standard of data in the world. We're also relying on private sector surveys, which have been collected for many, many years, and we can correlate them with the government-collected data over time and know exactly how they relate to one another. And then, of course, there's really no replacement, especially at inflection points in the economy, for talking to businesses, workers, communities, and consumers, asking people what they're really doing. And then I like to do this: go to the parking lots of your favorite retail stores and look at how many cars are in the parking lot and what people are buying. That tells you a lot. Airports are full, people are out there. You can go to a sporting event or a concert, see how many people are there. What you see is an economy that is slower than it was. Consumers that are not, they're more picky about what they spend on, but they're still out there participating in the economy. And that's how we get the information we need to make the right decisions that are according to our mandates, but mostly for the American people.
President Daly, you've been working with the Fed or on the Fed committee for a long, long time in these debates. Have you ever seen it more divided than it is right now on the FOMC?
Of course. I mean, if you look at the transcripts and the meeting minutes, and it's helpful, go back and look at the 1990s debates and go back and look at the commentary around the 1970s. It is a misnomer to think people always agree. The right way to think about it, in my judgment, this has been my experience, is that the debate we have, I wouldn't even call it division. I would call it differences of opinion that are really healthy in a debate about trying to make policy in an uncertain time with no truth. We don't have truth. We have forecasts. We have our best estimates. We have taking the evidence and then taking it again and looking through it with different lenses. I see that as a strength of the committee, a strength of the Federal Reserve, and importantly, is delivering the best possible decisions we can make. So I have seen this many times before, and I think it's always at inflection points that you see the broadest amount of disagreement, and it's exactly what I hope people would want from a committee making decisions on inflation and full employment. It really does help us make sure that we're doing the best we possibly can.
So you're happy to confirm on the record you have not seen Governor Myron and President Smith in a fight in the two-day meeting? Can we confirm that, President Daly, today? That hasn't happened.
You always try. And yet I'm not a rookie.
Mary Daly, thank you. As always, good to see you. The San Francisco Fed President, Mary Daly, I'd never accuse you of being a rookie.
Never. Honestly, her comments are really interesting and it highlights what a tenuous moment this is, really, given the fact that there are all these different overlays. I just wonder how different the neutral rate would be if we're in the 1970s versus the 1990s and what that does for a Fed that is incredibly divided at an inflection point.
They are really in a difficult moment right now, in a very difficult spot. Mike McKee's going to join us now for more. Mike, you were tracking that conversation. You've got one of your own a little bit later.
Yeah, we're going to talk to Alberto Musalem, who is a voter this year, and I suspect that at least Mary Daly's answer on what happens in December is going to be sort of the template for him as well. We don't know yet. We're going to look at the data and wait until the last minute, because this is a time when they can do that, and we give them something of a pass because we don't have the data either. I had two thoughts on Mary Daly. One is on the productivity question. Yes, AI could produce a big jump in productivity, but when? And right now is when we're talking about the monetary policy moves that will take effect maybe 6 months to a year from now. But how long is it going to take AI to get in there? And two, on the jobs aspect of it, if you are an illegal immigrant, you're not going to come out to seek a job, even if employers bid up wages. And if you're legal, you might not either, for the same reason. And there's also a question about the skills that federal workers who've been laid off have. Are they going to be able to find jobs in the private sector fairly easily? It's a very complicated picture, so I'm not sure whether her arguments are correct or not.
Mike McKee, thank you, sir. Looking forward to the debate, your conversation that you'll have a little bit later, more insight into the debate on the FOMC. Your question's the right one. Look, we've seen a divided Fed before. We've seen dissent before, but this feels particularly unique. Two-way dissent, really difficult moment, a feeling that this low churn dynamic can't continue forever. It's got to cut one way or the other. And we've said a few times, by the time this conversation is complete, one half of the committee won't look very smart. The other half of the committee will look very smart, and I'm not sure which half is which.
Yeah, and to understand that it is a complicated moment is important. I mean, everyone who comes on the show has a completely different view as well. You just wonder how you set policy going forward and how relevant some of these things are going to be going forward. I'm just trying to wrap my head around it. You talked about mental gymnastics. It feels like mental gymnastics. You know, the idea of the AI overlay on a cyclical economy that's equally confusing is enough to make anyone's Monday very exciting.
We made the promise a few hours ago we'd tie ourselves in knots.
We did it.
We have. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. President Donald Trump pardoned people who were allegedly involved in the attempt to overturn the 2020 presidential election. Those pardoned included Rudy Giuliani, Sidney Powell, Mark Meadows, and several 2020 campaign aides accused of sending false elector lists from three states to Congress in an effort to keep Trump in power. Meanwhile, Robinhood shares are getting a boost up 3.7%. According to the Financial Times, the company plans to give users the opportunity to invest in some private AI firms. The trading platform aims to do so by offering tradable shares in a new fund managed by its subsidiary, Robinhood Ventures, which they say will invest in a portfolio of 5 or more private companies. And 2 Major League Baseball players were indicted over the weekend on charges pertaining to gambling fraud. Cleveland Guardians pitchers Luis Ortiz and Emmanuel Clase were charged with fraud, conspiracy, and bribery. They face allegations of throwing specific pitches during game situations so gamblers could place corresponding bets. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for this morning. Up next, Peter Supino of Wolfe Research with media earnings on deck. That conversation up next. Live from New York. You're watching Bloomberg TV.
If you look at inflation, you're seeing that it's been pretty contained so far in the goods prices, which have been directly tariffed. Look at productivity, and you see that productivity is rising, GDP growth is rising, while the labor market is slowing. So the 50 basis point adjustment we've made has helped support the labor market, but still keeps policy restrictive so that we can put downward pressure on inflation.
Just moments ago, that was the San Francisco Fed President Mary Daly weighing in on the debate of the moment at a very divided Federal Reserve. Let's turn to the earnings. Paramount Skydance reporting after the closing bell as investors speculate on its reported bid for Warner Brothers Discovery. Peter Supino of Wolfe Research joins us now for more. Peter, welcome to the program, sir. David Ellison on the call a little bit later. What do you want to know?
Well,
David Ellison's plans are ambitious, and so there are so many questions, and many of them are as yet unanswered. They shared a lot of strategic perspectives when they closed on the company, but they're all initial, preliminary, high level, and so we can't wait to hear what they have to say about everything from cost reductions to their ways to grow their streaming business, and at the core, what they'll do to invest in the studio, because this business, first and foremost, is a studio business. How they go to market is another question.
How do you win in this environment, Peter, other than just sort of trying to get into the sports game? What is the winning recipe?
Yeah, I like the way you framed that. Sports is an important traffic acquisition tool if your goal is to be everything to everyone every day, or to have something for everyone every day, which is roughly the way Paramount described their streaming strategy. But once you bring them in the front door with the sports, which is sort of the milk in the grocery store analogy, it's the low margin regular traffic driver, you need to be able to sell them something that's really profitable. And that's the trick with Paramount. Their content has had big highlights, especially Taylor Sheridan's work. But there has not been enough breadth of fresh scripted content to keep people coming back historically. And that's why the company only has about 70 million global subscribers, of which about 2/3 come in through other companies.
So, Peter, how much can they raise prices on us?
It was funny listening to Mary Daly a few minutes ago talk about inflation. One part of the economy which has had no problem increasing prices has been streaming video. Today, 3 major streaming services will cost you close to $80 unless you want to accept advertising insertion. And the top 5 streamers will cost you over $100 on a premium basis. So everybody in the ecosystem has pricing power. Paramount Plus has tested the pricing lever quite a bit. They're somewhat inhibited, though, because of those 2/3 of the customers that come through third parties. When you are distributing through a third party, your pricing is not the same as the retail pricing. You have to negotiate with Amazon and Roku and Charter and other distributors to get your net cut. And that's an important long-term strategic limitation for Paramount Plus.
Peter, this was great. Hopefully we can do this again later this week, and we'll talk about the Walt Disney Company as well and take stock of these earnings after the close. That was Peter Supino of Wolf Research. Hulu's killing me. I mean, you're setting me up for this. It is driving me
this might have been intentional.
Absolutely nuts.
Well, yeah, and the package. It's like, what happened? Just the bundle. I mean, we're going to be spending like $300 a month soon.
Let's just go back to that, shall we?
100%.
Landman 2. Looking forward to getting into that. There we go.
Coming
there we go.
soon.
Shout out Paramount for that one. Coming up tomorrow, Jeff Curry of Carlyle, Sheila Kahlu of Jefferies, Henrietta Trays of Vader Partners, and Omar Aguilar of Schwab Asset Management. From New York City, this is Bloomberg.